And countdown to the CPI here on the Countdown to the Close, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to closing bell here in the U.S. And it's a pretty quiet day, again, as we await those inflation figures that Romaine just talked about. You take a look at the S&P 500 right now, pretty much unchanged on the day. It's the same thing if you look at the big tech index, the NASDAQ 100, lower by about 0.2%, nothing too major. You take a look at what's going on in the bond space. It's also pretty quiet relative to the past few months that we've had. The 10-year yield down about 2 basis points at the moment. You are seeing more action when it comes to the energy market. You take a look at crude oil, remain up by 1.6%. That's after OPEC came out and basically argued against excessively negative sentiment.
Yeah, it's going to be a big week for oil. A lot of other data scheduled to come out on Tuesday, Wednesday, and Thursday. But of course, it's also going to be a big week as we learn about the health of the U.S. consumer. We're watching from earnings report from names this week, including Walmart, Target, TJX, Williams-Sonoma, Macy's, and Ross Stores, just to name a few. The major concern, of course, for investors is that persistent shift from spending on discretionary consumer goods to discretionary consumer services. That official government report on October retail sales also projected to hit this week and projected to reflect that trend with its first headline contraction after 6 straight months of growth. Now, remember, this is not only critical for the markets, but it's critical for economists and politicians alike who are now confronting that strange brew of still strong economic data, but deteriorating consumer sentiment. Betsy Stevenson, a former Labor Department economist who now teaches at the University of Michigan, she wrote in a Bloomberg opinion column today about that disconnect, saying maybe it's the prices, stupid. Economists focus on inflation. We know that. But consumers, they focus on the actual prices themselves. And those prices, while not growing nearly as fast as they were a year ago, they're still elevated across the board relative to 2 or 3 years ago. And that, of course, is the backdrop for the big event this week. Katie, the latest batch of official inflation data from the U.S. government starting Tuesday morning with the Consumer Price Index.
And as we drumbeat to those figures, let's take a look at where we stand right now. You have core inflation in blue, you have headline in white. So you're expected to see core basically hold steady at 4.1%. Again, going into the report tomorrow, you can see that headline, it was 3.7% at the latest reading, expected to drop down to 3.3%. But again, core expected to hold steady. So we'll see what that means for the Federal Reserve. But when you think about what it means for the bond market, we know that this chart that we've been seeing, the trajectory of inflation, it has translated into a lot of bond volatility. In white here, you have the MOVE index. That's basically the VIX, but for bonds. Then you have the traditional VIX in blue there, and you see this big divergence that has opened up. Of course, amid those Fed rate hikes, you can see that they spiked in tandem during the pandemic, and then this gap has basically grown. There's a lot of daylight between these two readings, and Romaine, it's going to be really important, really interesting to see what inflation readings tomorrow mean for that gap.
Well, let's pose that question to our first guest as we kick you off to the close. Gina Bolvin joining us. She's the president of Bolvin Wealth Management. And Gina, I think Katie put it pretty succinctly here. Everyone's still watching those inflation numbers. I thought the trend line was down. Why are we still scared?
Well, this is just a really big week for the market, and I think the CPI could be a catalyst if it comes out hotter than we're expecting. We are expecting 3.3, down from 3.7, and the market is all about inflation right now and what the Fed's going to do.
When you look at, I guess, what the Fed is going to do, or at least what the market thinks the Fed is going to do, there's really been no indication that they're about to move rates in any direction, really. I mean, I know they sort of keep that one rate hike on the table, but I think most people in the market believe that at a bare minimum, they're not going to go any further than where they've gone right now. Do you buy that?
I do buy it, and I think that segues into this week in retail and what we're going to see from Home Depot, Target, Walmart, TJX, because this is going to give us insight into the consumer. And we are seeing that the consumer is slowing down. We also saw the University of Michigan Consumer Sentiment Survey that's showing that consumers, they're pretty cranky, but yet they're still spending. And let's talk about that all-important holiday sales. what are we going to see this week, and how is this going to affect the bottom line at some of these stores?
And Gina, when you put it all together into a view on the markets, again, you have that dynamic which has been in place for a while, the fact that consumers are miserable by most measures, but they're still spending. And of course, that's propping up this economy along with the labor market. How does that translate into how you should be positioned in risk assets and beyond?
You know what, I'm still bullish. And one of the reasons I'm bullish is because of the labor market. We are starting to see it soften, but it still remains relatively tight. Consumers have jobs, and, you still have that YOLO consumer left over from YOLO, you only live once, left over from the pandemic, and they're still spending money. They have jobs. I think that's going to continue. We've just come out of earnings season, and look at all of the headwinds the consumer and businesses have had to deal with for 2023. Coming into the year, we didn't expect as many rate hikes as we had. We had a full-blown banking crisis. There was a lot going on, and still businesses did well. The consumer continued to spend, and I think that resilience will continue.
Well, YOLO is certainly the mantra by which I live my life, apparently some of these consumers and stock investors as well. But you mentioned earnings season, and of course, we're pretty much at the tail end of earnings season. It seems like it's a mixed bag, but from where you're sitting, what grade would you give to this earnings season? And when it comes to your bullishness, did it add to it, or was it just necessarily maybe not bad enough to detract from it?
It was good enough, and I would give it a C. I would give it a C plus. We've seen overall growth increased by about 7%. Although estimates are being lowered, but it was pretty good. I think it had a high bar, especially with technology, to get over, and I think it did good enough. But I do think this is an important week.
When you look, though, I guess at some of the commentary that we've gotten out of companies so far during this earnings season, Gina, a lot of folks, a lot of those executives seem to be concerned about, I guess, just how much gas is left in the consumer tank. And we've heard this time and time again, with a lot of nuance around it, of course. But there is this sense here that sort of the boom times for us spending, that might be behind us.
And that very well could be, but that leads us into, are we going to have a recession? Is the consumer going to slow enough to, have a recession? And is the Fed going to continue to hike rates, or are they going to cut rates? The market's pricing in a 25% chance of a rate cut for March. And I think that, everyone's talking about higher for longer, but I think that it's also an election year, and they may have to cut rates and keep the economy from avoiding a recession. And I do think we are going to get that soft landing.
All right, Gina, great to talk to you. Gina Bolvin there, president of Bolvin Wealth Management, helping us kick you off to the close here on this Monday afternoon. As we started the show, some breaking news crossing the wire on the highest court in the United States. The Supreme Court, we're now learning, is adopting a binding code of conduct for the first time, responding to a stream of ethics controversies. Of course, this is a court, I think, established back in the 1790s, and throughout that entire history, never has it had a formal code of conduct or a formal ethics guidelines here. But of course, some of the reporting around that man you see on the screen, Justice Clarence Thomas, as well as Samuel Alito, and a few other members of Congress, and their relationships that they have with some very powerful political donors has raised a lot of questions here about their impartiality. Right now, the U.S. Supreme Court is now adopting a binding code of conduct. We're learning that that code of conduct goes into effect today. A lot more coming up here on the big program, including a focus on the APEC summit taking place out in San Francisco this week, where President Biden is set to meet face-to-face with China President Xi Jinping. We're going to get a preview on what both sides are hoping to accomplish.
Plus, while the U.S. still faces a risk of a government shutdown at the end of this week, that's despite a new compromise plan by Speaker Mike Johnson. We'll bring you the latest.
And we're going to talk about dating apps and why some investors are falling out of love with the dating apps this year. That conversation and so much more coming up here on The Close. This is Bloomberg.
Well, Well, it's a tale of two Fed outlooks, Morgan Stanley versus Goldman Sachs. Goldman in one corner expecting fewer cuts and a later start. On the other hand, you have Morgan Stanley anticipating deeper rate cuts over the next 2 years, ending in the low 2% range in the fourth quarter of 2025. Morgan Stanley's Ellen Zentner writing, quote, "We maintain our view that the Fed will achieve a soft landing, but weakening growth will keep recession fears alive." Bloomberg's Mike McKee joins us now to help break it down. When you think about the deep cuts that the Morgan Stanley camp is anticipating, it's not necessarily a recession call, but what would lead the Fed to actually deliver those kinds of deep cuts?
A recession.
Yeah.
Here's the good news about this exercise here is, as John Authors put it, this is the time of year when every analyst on Wall Street's writing their 2024 look ahead. And they're always wrong, and it's a good exercise for them to think about things as they go forward. I say this is basically about the same as political polls a year out from an election. They don't add any value, but it's something to talk about. And here's why. You take a look at what the forecasts were for the U.S. economy in October of 2022 and compare them to what they are now in October of 2023. And they're completely different for the same quarters. So everything changes, and you really don't know what it's going to be like. So it's hard to say that there's a whole lot in here that you could do much with.
Yeah, I certainly agree with you. And I mean, of course, a lot of hay will be made about how wrong they are. But I will say in their defense, there does seem to be, with some of the reports at least, an underlying narrative that they also weave together. So even though the numbers themselves might be proven to be a little bit off, sometimes that underlying narrative is still true. And you saw that with some of the projections on economic conditions that started to come out late last year and earlier this year.
Well, if you look at their sort of underlying work here, both of them are saying essentially the same thing. It's a matter of degree, how much they're anticipating they will cut. And for that, you can go look at the dot plot. And if we have it here, I took the dot plot and I put Goldman Sachs and Morgan Stanley into it.
Okay.
And basically what you end up seeing is they're as divided as the Fed.
Yeah.
For 2025, the Fed has no idea.
Yeah.
They think they're going to be cutting. You can see all those lower dots, but they don't have any idea where they're going to be cutting to. And so that's the problem here.
That 2025 dispersion is astonishing.
Yeah.
But I guess maybe it's not, given that it's a year away.
Well, this is 2023. That's
Yeah.
2025. 2 years ago, when we were in 2021, we were coming out of the pandemic, and we had no idea.
So many lives we have lived since 2021. So point taken that, everything will change, and maybe we'll make fun of these in a year from now. But it seems like we can all agree across Wall Street that the consensus is that the Fed is going to start cutting next year.
And the consensus, the informal consensus at the Fed is that they're going to start cutting this year. They said that in their dot plot, and they've said that in their outlook, economic outlooks. They just don't know when and by how much. They're going to keep rates unchanged until they feel that inflation is coming down to 2%. Exactly what that means, maybe 2.5%, something like that. But until they get there, they don't have any plans to cut rates. So it's hard to put timing on that because we don't know how inflation will react. Then it just depends on how far inflation falls.
All right, a lot of uncertainties out there, but not stopping folks from making predictions. Michael McKee, our international economics and policy correspondent, helping us walk through it. And speaking of some of those uncertainties that are a little bit hard to forecast, well, there's a lot going on right now about another U.S. government shutdown. Just 4 days away before a self-imposed deadline of November 17th, the House scheduled to vote on a compromise plan from Speaker Mike Johnson as soon as tomorrow, but conservatives already saying that they plan to block it. And even if the measure passes, the president said he might actually veto it. Let's get some insights out of Gregory Cordy, our Bloomberg politics editor down in Washington. And first, let's start off with whatever this plan is that's on the table, because I was a little confused by it, Gregory. I mean, it was this basically a stopgap measure that would just basically give them more time to come up with a longer term measure. I thought this is kind of sort of the same issue that led to the whole speaker uprooting a few weeks ago to begin with.
Yeah, absolutely. I mean, it's deja vu. You remember 6 weeks ago, this was the issue that brought down former House Speaker Kevin McCarthy when he made a deal with Democrats to try to get a short-term spending bill through the House, and then all of a sudden found an insurrection on his right flank who deposed him as Speaker. Now, after a chaotic 3-week search for a new Speaker, we have Speaker Mike Johnson trying to pull the same maneuver, and the math hasn't changed. The one thing he has tried to change here is he's divided up this clean continuing resolution, this stopgap spending measure. He's divided into two different bills that expire on different dates in January, February of next year. And he's hoping that that will give some of his hardliners a little bit of breathing room, because one of the demands of conservatives in the House is that let's not do all this spending in one package. Let's divide it up so we can talk about spending on the merits as opposed to just continuing everything at the same rate. He's hoping that will win over some conservative votes, but it doesn't seem to be working quite yet.
Well, Greg, that's kind of the question I have. When you think about the math, and to your point that the math hasn't changed, does he have a better shot at winning over those hardline conservatives, or trying to appeal to maybe some Democrats here?
Well, I mean, he's certainly banking on a reservoir of goodwill, this honeymoon that he has as Speaker. And there are a certain number of conservatives who will say, look, I don't like this deal, but I want to give this new Speaker a chance. Then you have Democrats who, what we saw in the Speaker fight is they weren't going to lend votes to help bail out Republicans as they were flailing around looking for a new Speaker. This is a little bit different dynamic. So all eyes tonight, this afternoon, are on President Joe Biden. If he issues a veto threat, that'll make it a lot harder for Speaker Johnson to get those Democratic votes that he might need to get this over the finish line. Remember, he only can afford to lose 3 Republican votes if all the Democrats are united against this and get something passed. So he's going to more than likely need at least some Democratic votes.
All right, Greg, it's going to be a hectic couple of days, to say the least. Really appreciate your time and your reporting. Our thanks to Greg Cordy, Bloomberg White House and politics reporter. Romaine, razor-thin margins. Feels like we've been here before.
Yeah, like we've been here before, and it kind of makes you wonder what Mike Johnson has been doing. I mean, he took off on a flight to go overseas for some far right-wing conference. Meanwhile, his caucus back here is just still in disarray. I don't know what he can offer them because, I mean, again, it gets to this idea that the compromises that would be on the table were, I would think, some of the same compromises that failed McCarthy. So it's kind of like, how do you thread that needle there, appeasing to your base, but at the same time putting something on the table that the Democrats, at least enough Democrats, but we would be willing to splinter off and vote for?
Well, an incredibly tricky needle to thread and not a lot of time to do it. Of course, we'll be following that all week. But of course, coming up, we're also following President Biden set to meet face-to-face with China's President Xi Jinping in San Francisco this week. We'll get a preview of what both sides are hoping to accomplish. This is The Close on Bloomberg.
The summit of the Asia-Pacific Economic Council set to take place in San Francisco this week, but the real event is the potential meetup between President Joe Biden and Chinese President Xi Jinping, set to meet face-to-face for the first time in more than a year here, with lots of discussions here about economic cooperation and, more importantly, some thaw in the diplomacy that we've seen try to take place over the last few days and weeks. Ian Marlowe joining us right now, who covers diplomacy for us here at Bloomberg. And Ian, let's start off here just with the symbolism of just these two men meeting face to face. Presumably, we're going to hear something from them publicly. Whether it actually results in anything concrete in the short term, is there anything that investors, I guess, can find, any solace, I guess, they can find in the fact that the meeting itself takes place?
Yeah, I think that's one of the things we've been looking for from the beginning, from the time the U.S. started this kind of renewed push with diplomacy with Secretary Blinken's trip to China back in June. I think a lot of people have just been looking at a sort of more stable U.S.-China relationship as something that could be beneficial for the global economy. When it comes to specific concrete things out of this particular meeting that they could look for, other than there's been reports that, that China may unfreeze some Boeing sales. Other than that, some of the other things are more on the political side. The U.S. has been pushing China to crack down on precursor chemicals used in fentanyl. So the U.S. is hoping for some progress there. And there also may be some agreement, not to weaponize AI technologies between the U.S. and China, but whether that would have any commercial ramifications is probably pretty doubtful, at least in the short term.
Well, Ian, as you just laid out, there is plenty to talk about here. A lot of issues that are theoretically going to be addressed. When you think about where the U.S., where China is on these various issues, where is the gulf the biggest?
Yeah, I mean, I think the Gulf is probably the biggest on military-to-military communications. That's something that the U.S. has pushed for with China, just to make sure the two militaries are in touch. I mean, you've probably seen, in the news over the past little bit, these intercepts between U.S. and Chinese vessels and aircraft, over international waters in Asia. And that's something the U.S. is really, really worried about. But it's also something that a lot of people doubt China will make significant progress on. Even if there is some sort of agreement, there's a chance that, if there's a hotline, for instance, that China doesn't pick up the phone, when push comes to shove out there. And that's something the U.S. is really nervous about in terms of avoiding an actual inadvertent conflict with China.
One, I guess, elephant in the room here, if you will, Ian, forgive the pun, is the idea of continuity in U.S. policy towards China. And we know that in the past, that has sort of rattled some of the Chinese negotiators, obviously during the Trump administration, and then the uncertainty as to what the transition would be like to the Biden administration. There is certainly a real possibility that in a year or so's time, we'll have a different president. Is there any sort of assurance that the U.S., that the current administration can give the Chinese that if something does change in the next year and a half or so, that they can expect at least some modicum of continuity in the promises made today?
I don't think there is, and I think that's probably one of the things that's keeping Chinese negotiators on their toes here, as you've said. I mean, the previous administration's attempt, threw China off balance a little bit, and I think they were maybe surprised that this administration kept a lot of those policies in place, and we still see them sort of narrowing the focus to some degree on high technology, semiconductors, and other things like that, which have had an impact for investors. But it's not clear, whether it's on Iran or on China, that any U.S. administration can make any sort of assurances. And I think in this case, they probably maybe wouldn't even want to, because it does give them a little bit of an advantage in terms of some of this stuff. But at least when it comes to the diplomatic re-engagement with this administration, there's been a lot of FaceTime over the past little bit, and that's been a big change, from the months, preceding at least Blinken's visit back in June.
Yeah, absolutely. So definitely the optics, definitely a little bit better than what we saw maybe a year or so ago. Ian Marlowe, Bloomberg senior reporter covering diplomacy ahead of that APEC summit now taking place out there in San Francisco. And of course, the headliners, Katie Greifeld, on Wednesday, we're expected to see Xi Jinping and Joe Biden meet for the first time. I think something that would actually help, just in the court of public opinion, is if Xi Jinping agreed to give those pandas back to us. I was really upset by my attitude towards China completely turned.
You think about acts of goodwill, that would certainly be a big one.
Yeah.
So we'll see. I would imagine they'll talk about it.
Yeah, I think it's big news here. A lot more coming up here on The Close. This is Bloomberg. This is the countdown to the close. Taking a look at markets right now. Equity's still a mixed bag. So too are treasuries, but a little bit more activity right now in the commodity space with crude oil up for a third straight day. Abigail Doolittle standing by right now with our commodities close.
And it's that rally in crude oil that's really driving the commodity space, Romaine, because we do have the Bloomberg Commodity Index up more than 1%. Yes, the dollar is down, but just modestly. So a really wide divide with stocks, the difference between these two segments of risk assets within that overall silo. So crude oil breaking a 3-week down streak, a little bit of reprieve here, as Romaine mentioned, up 3 days in a row. Natural gas up 5.5%. This as colder weather forecasts take hold. Copper up 2.3%. And we have a lot of the metals rallying ahead of CPI, ahead of retail sales, ahead of PPI, including copper. And then soybeans up 2.8%, up for a second day in a row. And some of this has to do with some activity out of China, Romaine.
Absolutely. Here, let's keep an eye here on what's going on further in the commodity space and a closer look at lithium. ExxonMobil is making its first major foray outside of fossil fuels in decades. The oil giant is working to become one of the biggest suppliers of lithium for electric vehicles. Big oil reporter Kevin Crowley joining us with the story from Houston here. And Kevin, let's start off here with this idea of just how far is Exxon willing to go into this space? Is this just going to be some sort of side gig, or is this going to become a core component of its business?
Well, certainly to begin with, it starts off as a bit of a side gig. I mean, this is they're still, oil and gas is still core to their business model, but they are going hard into lithium, and they're doing it in a particularly new way called direct lithium extraction, which is quite a different way that lithium is produced currently. But Exxon has big plans. They see scaling up to 100,000 tons per year. By 2030 or so, which would likely put it into the top 10 lithium producers globally. So they certainly have big aspirations. They will be the pace will be determined by the market, but they see lithium demand quadrupling by 2030. So they see plenty of space to grow here.
Kevin, I love this story because I learned a lot. So the lithium, it's going to be extracted from underground salt reservoirs in the Smackover Formation in southern Arkansas. Like you said, big plans to about 100,000 tons a year. What is that going to cost Exxon to scale up to that point?
So they haven't given any numbers yet, but it will start off in the hundreds of millions of dollars, and by 2030 they expect to be spending billions of dollars in this area. Now that's Exxon is used to spending billions and billions of dollars on large mega projects around the world. So this is not something that's completely outside of their wheelhouse. And the process is pretty interesting indeed. Most lithium at the moment is mined through either hard rock mining or through brine ponds, which you just showed there on the screen. But Exxon wants to do this through direct lithium extraction, which is like you said, it's pumping brine water from reservoirs in southern Arkansas and then processing them to take the lithium out.
Well, I'm curious about one thing here. I mean, this isn't exactly there's a lot of players in this space, let's just say. There are a lot of folks that are already doing this. So I'm not sure what exactly makes Exxon special in this space. Also, the whole idea of lithium being relatively widely available, it's more just about the environmental impact and how you sort of mine this in a way that doesn't run afoul of some of the regulations out there. What is the secret sauce that Exxon's going to have that, say, their competitors like Albemarle or Lithium Americas won't have?
Yeah, so they think this direct lithium extraction process, which is not commonly used at the moment, is both cheaper and has a lower environmental footprint, and they believe that can give them the edge. Because of course, lots of buyers of these metals are making electric cars, and they want metals produced in the least environmentally impactful way possible. So Exxon believes that they can offer them this. Plus, as well, it's domestically produced metal as opposed to bringing in from overseas. So they see that there's an advantage there too.
All right, Kevin, got to leave it there. Really appreciate your time. Our thanks to Bloomberg's Kevin Crowley. Now, still ahead, a disappointing earnings season for dating apps is leaving matchmaking services on rocky ground with investors. More on that next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with PepsiCo. Jefferies restarting coverage of Pepsi and other consumer staples and beverage companies. The analyst viewing Pepsi as the most durable business among the group and says the stock could very well top Coca-Cola's market value in the next few years. He attributes that to a large part to Frito-Lay snack business that Pepsi has, saying that Coca-Cola is exclusively a beverage company, which gives Pepsi the upper hand. Those shares up 0.8%. Next, let's take a look at CrowdStrike, getting raised to buy from hold over at Stifel, and the price target boosted all the way to $225 from $153 a share. The analyst says CrowdStrike remains the leader in the cybersecurity space and says he expects the company to benefit from a platform consolidation that's going to play out across the broader cybersecurity industry. Shares higher by 2% on the day. And finally, let's take a look at HP. HP Inc. upgraded to buy from neutral over at Citi, with the analyst confident that demand for personal computers will pick up, especially as artificial intelligence tools are added to some of those newer models. Expect this to drive revenue growth and free cash flow generation, so says the analyst. Shares higher by 0.6% on the day. And those are some of our top calls. We're going to shift gears just a little bit to the world of online dating. Both users and investors are curious about pricing plans on platforms like Bumble and apps run by Match Group. Joining us now for more on the cost and value of dating apps is Shweta Khajuria. She's research analyst over at Evercore ISI, and she rates Bumble and Match Group and outperform. Shweta, let's start off here with the performance of these stocks. We know they're both down this year. I believe they were both down last year as well. Why is it that investors seem to have soured on some of these names?
Well, first of all, thanks for having me. In terms of the investor sentiment on dating apps, there are a few things that have the category as a whole have seen several headwinds. So let's take Match. Match is the category leader. It is the category, really, with a huge market share. And the biggest problem that Match is facing today is Tinder. Tinder is over 50% of their direct revenue. It's the highest margin asset. And what recently, over the past several quarters now, call it 5 quarters, what Tinder has experienced is their payer growth has been deteriorating in the sense that net adds or net additions, sequential growth of payers has been negative for the past 5 sequential quarters. When the biggest asset in the category leader is turning negative, that is a question mark among investors. And that is why we've seen the stock move the way it has moved.
Yeah.
The same thing, similarly with Bumble. Bumble, the fundamentals are healthy, but because it's category player number 2, the valuation is somewhat correlated with how Match does. And so it is very much linked in terms of the multiple it gets.
There's a broader question out there right now about how these platforms, I guess, are taking their approach that they're taking to pricing and whether that has had an effect on engagement on the apps. I mean, dating is never going away. There's always going to be a large pool of people looking to, meet up or hook up with other people here. So I'm wondering that if the actual growth isn't there in terms of number of people coming to the platforms, what are the platforms themselves doing that might be contributing to that?
Well, so the category as a whole is expected to grow, call it high single-digit percentage. There is the online dating penetration, if we just look at it at a high level, in the developed markets, it's somewhat known that it is about 50 to 50% plus penetrated in US and in Western Europe. The opportunity is in developed markets such as LATAM, in Asia, APAC, et cetera, where the penetration rates are still in the high teens. So there's much more room to grow in those markets. And that's where we're seeing Hinge and Bumble really accelerate growth rate in international markets. Now, what can these apps do in the developed markets? One thing that Match has done is clearly increase prices at Tinder. We've seen that come at the cost of payers. Payers have taken a hit because of the price increase, but going forward in a normalized environment, what can they do? These are product-based apps. So if the product does not improve fundamentally, whether it is increasing match rates or increasing the number of connections that you can establish on these apps, the value proposition that users get, then users are going to move on to something else, and these apps will lose its value proposition. So the number one thing that both management teams at Match, at Tinder, at Hinge, and at Bumble are focused on is driving greater value proposition through their product, through product improvement. If they can do that, then payer conversion can ultimately go up.
Well, just to meditate on the pricing a little bit more, situate this conversation and what we're seeing in the economic backdrop. Of course, we know inflation has been an issue. We've seen maybe consumers start to cut back. When you think about raising prices at Match, potentially at Bumble as well, and you think about the consumer that they're serving, how much of a risk is that when they cut back, they'll choose to cut back on these dating apps?
Well, it is highly debatable if the price increase at Tinder was the right timing. I mean, there are bulls on the stock who think that it was the right thing to do with the new management team coming in. Then there are those who believe that it was the wrong timing given the macro concerns, even though Tinder prices historically have been well below Hinge and Bumble. So they were just right sizing the pricing with the price increase, but they saw that with the payer hit. Now, on a go-forward basis, what Match management team called out as a part of the exposure to student loan repayment beginning in the fourth quarter, they call it out as a 1 to 2 point headwind to the growth, and predominantly coming from the Gen Z cohort because that's the cohort that has the most exposure to the student loan repayment. If macro going forward beyond the student loan repayment gets worse, I would imagine that would be a greater headwind, although mostly from a la carte followed by subscription.
All right, Shweta, great to catch up with you and really great insights here. A closer look, Bumble Match and the rest of the dating apps out there. Shweta Khajuria, she's a research analyst over at Evercore ISI. A closer look there at our top calls. And Katie, this gets to an issue though too. And I mean, and this is obviously anecdotal. It's hard to pin down. But I have friends who are still in the dating scene, and a lot of them have complained. They're saying that the types of fees and add-ons that these sites are adding is kind of discouraging them from actually participating on the app. And a lot of them have actually said that it's now easier just to go out in the old-fashioned way and meet people, you know, in gyms and bars and restaurants.
I guess it depends on how you see it. I mean, when you think about these dating apps, is that a staple or is that a discretionary item in your own personal budget? And I guess that's a personal decision.
It just depends on how needy you are.
That's true.
All right. Well, but you saw the share prices though too. I was actually surprised with that. And not only significantly down, what, like 20-30% on a year-to-date basis, but they were down pretty significantly last year too.
Record lows, I believe, for both Match and Bumble. So it's been rough out there.
All right. Well, maybe the only way to go now is up.
It's true.
All right, coming up here, we're going to focus in on what's been going on in America's universities and colleges. Gilpin Faust, she's a former president over at Harvard University. She's stopping by to discuss her memoir, Necessary Trouble, Growing Up at Mid-Century, and will bring us through the similarities and differences of some of the conflicts that we're seeing today and what she saw back in the 1960s. This is The Close on Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, I'm sure as you know, and there's been a lot of protests on college campuses across this country in the wake of the Israel-Hamas war here. And let's just say there's a big debate going on right now about free speech and about how these universities are dealing with people wanting to voice their opinions.
That's certainly true. By the way, having been in college in the 70s, we had it in the 70s in a very different context. But we're seeing it once again now. We're going to bring in somebody who really has a perspective on this. She's Gilpin Faust. She was the first female president of Harvard, and she's the author of Necessary Trouble, Growing Up at Mid-Century. So, Dr. Faust, thank you so much for being with us. At the very beginning, the foreword of your book, you say history is about choices. You, of course, are an historian. It's about choices, and a lot of your book is about choices you observed and participated in the middle of last century. I wonder if, as an historian, you could compare and contrast what we saw in the middle of last century, largely having to do with civil rights, with what we're seeing on college campuses today in the context of the Israeli-Hamas conflict.
Well, I can try to make some comparisons. I always think it's dangerous to try to connect too directly between the past in an effort to somehow predict the present. But let me say a few things about what I feel the distinctive characteristics of those demonstrations were in my college era. I'm struck by, first of all, the impact of social media on demonstrations today and on the ability of people to organize, but also the ability of people to target not just groups, but individuals and call them out and put their names up for others to attack. And of course, none of that was available to us in the 1960s. And I should say I was an activist both in civil rights demonstrations, but also in the anti-war movement. I graduated from college in 1968. And my book really traces those years. It traces my life from 1947 to when I turned 21 in 1968 and ends with a consideration of what those demonstrations were like. We could not communicate as rapidly. We could not identify people as rapidly. We could not target people as rapidly or as effectively. And so I think that has led to a very quick escalation and a dramatic escalation in the ability to express oneself, but also to disrupt the lives of others and to disrupt the lives of those around us in the present day. So I'd say that's one distinctive difference. Another thing that strikes me as notable is my generation of college students felt it wanted to distance itself from its parents and from adults. We felt we knew more, we were smarter, we saw a new world dawning that those older than us did not. The attack on regulations in colleges, particularly for women, parietals, they were called, rules, other kinds of controls. These were the what we wanted to oppose. And when we expressed ourselves politically, I think we would have been astonished by the idea of trying to get statements from our own universities about their views on the issues at hand. That has obviously been a huge focus of college students and campuses today, because I believe that students are now much closer to their parents, to an older generation, to those who've come before, and to the institutions in which they find themselves. And so they want kind of the endorsement and approval of those institutions, and they want those institutions to take a stand. That was quite different. Right. From my era. For example, we might ask an institution not to give the federal government the record of male students' grades, because the draft operated in Vietnam at one point on the basis of how well you were doing in college. If you weren't doing well, you were subject to the draft. If you were doing well, you would have a lower likelihood of being drafted. So we would demand things from the institutions of that sort, like do not send in the record of grades. But there wasn't that same sense of endorse us that is now very much a part of the conflicts that are currently underway.
I am curious, though. I mean, as an administrator, and you know this. I mean, just from your time in college, and I think we all know this, that you know, kids of a certain age, I mean, we say and do things. We're passionate about things here, and universities are kind of supposed to be that space that allows folks to have that discourse, obviously in a constructive way, but nevertheless to have that discourse here. So given all the sort of things that you mentioned there, the sort of the modernization of a lot of the issues that have now made it more complicated to have that discourse, how do university presidents and other administrations, I guess, address that without just basically shutting down discourse altogether?
You know, I'm not going to answer that question because I'm not a university president. I have a successor who is undertaking this, and I no way want to position her by coming up with what I think she ought to be doing. I'm not in the middle of all the pressures. I'm not seeing what she's seeing. My day at running Harvard is over and has been over since 2018. So I believe that it's important to let those who are responsible and charged with these responsibilities to carry them out, independent of my holding forth about what I might have done had I still been in office. I will say that when I was president, the first number of years, I became president in 2007. And students were pretty quiet for a while. And then with Occupy Wall Street and rising intense feelings about climate change and divestment, the student body became much more active and much more engaged. And so we've seen, I believe, a kind of escalation of student activism, but also student concern about the world. And that characterizes the moment we find ourselves in now, and is both a challenge to universities, but also represents on the part of students passions that are worth considering as the hallmark of an individual who cares about the world in which they find themselves.
Dr. Faust, I certainly respect you don't want to second guess what's going on in any college campus today. But let me ask a related but somewhat different question. That is, how has the job of being a university president changed as you've watched it develop? Because it looks like there are a lot of stakeholders you have to be worried about right now, from the students to the faculty to the administration to, yes, donors and alums.
You've got a great word there, stakeholder. There are a lot of people who consider themselves constituents of any university. And for the president, that is obviously a source of great satisfaction that so many people care about universities. But it also means that there are competing voices coming at you all the time with often very different agendas and different perspectives. Those enrich your ability to do your job, but they can also be extremely challenging to reconcile when they're coming from different and sometimes conflicting points of view and conflicting interests.
Dr. Faust, thank you so very much for being here. Really appreciate this. Drew Gilpin Faust, former president of Harvard University. And on Friday's Wall Street Week, we're going to be joined by Tony James. You know him, Tony James of Jefferson River, originally from KKR. We're going to talk to him about the history of private equity and how it's developed over the years. As you know, Romaine, it's gotten a lot bigger.
Yeah.
And it's interesting the divergence, actually, among the big private equity firms.
Yeah, and they're kind of at another inflection point. And he's great to talk to because you think about where he was at the sort of the dawn of this new industry, and now the idea that everyone seems to think that it's set up for a big shakeup sometime soon.
Yeah, exactly. And it's getting a lot of pressure, as you know, because of interest rates and other things.
Yeah.
But we're going to be talking to him on Wall Street Week at 6 p.m. Eastern Time on Friday.
And of course, you can also catch David every day around this time here for his daily Wall Street Week segment right here on The Close as we round out into the final hour of trading here on this Monday afternoon. The price action somewhat tepid and the volume somewhat low, as most investors right now really waiting to see some of those official government reports. CPI tomorrow morning, 8:30 a.m. Washington time. That's going to be followed later this week by some big retail sales data, as well as other data points here on consumer spending. This is The Close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld. And we do have some breaking news to bring you. This coming out of Starbucks. Basically, the Starbucks union is planning for its largest ever strike on November 16th. Apparently, this would hit thousands of employees at hundreds of sites. Planned for November 16th. That is actually pegged to the company's Red Cup Day. It's a very popular day, Romaine. I don't know if you've ever been there, but they basically give out holiday-themed reusable cups. This is coming after Starbucks, according to the union, said that it's refusing to fairly negotiate at these cafes. So we'll see 3 days. We'll see if anything changes between now and then.
It'd be interesting to see if there's any real impact. I haven't set foot in a Starbucks in years. I don't really drink coffee, but I do wonder about. There's a lot that you don't know about me, Katie Greifeld. But what I will say is that when we talk about all the labor issues with these stores, and we see all those individual stores and some of the pushback against Starbucks here, and we know those efforts weren't as successful. So you do wonder if this is kind of a re-up of that, and whether we're just going to see the same sort of process play out where nothing ends up really happening. Yeah,
it'll be interesting to see how this plays out. You think about labor-intensive jobs, and a Starbucks barista is right up there. Starbucks shares currently off about 0.7%. Not too much of a reaction. Yeah, not too much of a reaction, and they were already down as far as the broader market here. It's been a mixed bag here. We should point out volume is incredibly light. I think we're about 20-25% below where we would normally be around this time, and I think that's because, Katie, a lot of folks are really waiting to find out what happens tomorrow with that CPI report, which comes out in the morning here. You take a look at your 10-year yield at 4.6 and NYMEX crude up for a third straight day here. Flip up the board, though, because I just want to point out something real quick to you, Katie, before we go through some of the individual movers, gainers and decliners here on the day. And that's really the idea that a lot of those short positions, at least on the broader market, have been completely unwound, at least if you believe what we're seeing in the CFTC data. Yeah, it's pretty neutral when you think about positioning right now, at least according to that slice of what the CFTC covers. But like you said, let's go through some movers right now. There's really only one I want to talk about. We put 3 on the board. I want to talk about Tyson. Oh, this was really interesting. It's the biggest U.S. meat producer. Basically, sales are going to remain flat in the fiscal year that started in October. Operating income expected to fall short. But let's talk about beef. They wrote down the value of their investments in beef. There's less cattle available for slaughter, and also buying fattened animals. Apparently, it's on its track for its 3rd straight annual increase. So there's a lot of drama when it comes to U.S. cattle right now. Yeah, the beef story is actually really interesting, too, because in one hand, you would think some of the dynamics going on would actually benefit the actual producers themselves. But we've heard from a couple others basically saying the same thing as Tyson. All right, let's also talk about Evercore. It's one of the biggest losers. Exactly, one of the biggest losers today. Don't have a good reason why. And really quickly, Henry Schein. Sales miss estimate, guidance lower than expected. Reversed, though, adjusted EPS came in about as expected. I love it. No real reason why, but we're going to mention it anyway. Stick with us. We are less than an hour away from those closing bells. Our cross-platform coverage, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Happy Monday to our Bloomberg audiences across all of our platforms, television, radio, originals, and our partnership with YouTube. Welcome back here, Carol Massar, on a day in the markets that I guess is kind of more of a holding pattern, right? I feel like everyone's just kind of waiting for the economic data because, of course, that's the feed through as to what the Fed might do next.
Absolutely. It's why that CPI print tomorrow is so important. Having said that, the most read story on the Bloomberg shows the division among the big Wall Street firms about kind of what comes next when it comes to said monetary policy. If you're looking at UBS and Morgan Stanley, they think the Fed is going to be a lot more aggressive when it comes to interest rate cuts next year as they see inflation cooling. Flip to Goldman Sachs, and they think it's going to be fewer reductions when it comes to interest rate cuts and maybe a later start. So to me, you guys, it says nobody really knows what happens next.
Yeah, what if both are wrong?
Then I guess what if the Fed is the one who's right? The federal funds rate, the Fed says, okay, it's going to be 3.9%. Let's talk a little more detail, though, about what these companies are saying, what these strategists are saying. UBS strategists see rates falling to between 2.5 and 2.75% by the end of the year. That's next year, with the terminal rate plunging to 1.25% by early 2025.
Yeah, and we should point out, too, we were talking with Michael McKee, our economics correspondent, a little bit earlier. And he also kind of pointed out the absurdity of some of these projections, given how far out they're trying to look. And obviously, that's the job of these strategists. But so much can change over the next few weeks and months. And he even pointed out, look, you go back to a year ago and you look at some of the economic projections that we got out of the same folks, some of the projections about the Fed rates. And of course, we know the vast majority of those folks were wrong.
Or calling for a recession.
Yeah.
Where is it? Where is it?
I don't know. And you think about what could actually deliver the kind of cuts that Morgan Stanley is anticipating. And
you know, where is it? Where is it? That is exactly what I said about Carol Massar all last week.
Where is
I didn't know where she. I don't know. It was like, where's Waldo? Where
she was only gone for a couple days.
Down. He just missed Carol so much. But can we talk about the Marvels? Apparently, no one went to see this.
I don't think anyone is talking about
this is a pretty amazing stat. It only generated $47 million in the U.S. and Canadian theater ticket sales this weekend. That is the lowest opening ever for this superhero franchise. I was not among the people who saw this movie.
Yeah, not too many people saw it. And there's been a lot of, hay made about the idea of whether they've just sort of run out of creative ideas and whether that kept people away or whether this was more a reflection of the fact that the actors couldn't actually promote the movie. I mean, there were a lot of people saying, hey, I didn't even know this movie was coming out.
I think that's fair to say.
Yeah.
Because of the actor strike, because of the writer strike before that, they were certainly limited in what they could do. Do you know that there have been 33 of these films?
No.
Isn't that wild?
Wow.
Okay, there was a great story. I've not seen them all. No, not even close. We tried to watch them during the pandemic. We made it through like 2 or 3 of them. Great article in Bloomberg Business Week, guys, about how long it would take if you sat down to watch all of the Marvel content that Disney's created since 2008.
Yeah.
How long?
You ready for this?
Yes.
31 days. 50 minutes.
Let's do it.
Okay.
Actually, let's go live life.
Entire month.
Okay.
That's pretty insane.
Non-stop watching.
I will say to the point that, the actors and the companies really haven't been able to promote these movies. I don't know if you guys watched SNL this past weekend, but Timothée Chalamet was the guest, and he mentioned Wonka a lot. So there you go. You got to get creative.
He can now promote.
Have you seen the trailer for that movie?
I don't think it's me, but I do like Timothée Chalamet.
Okay, well, maybe you'll be the only one that goes see that movie too, as well. Yeah, it gets to the broader issue though too. Is there a broader question about a movie going in general? I mean, I know we've had a couple of hits this year with Barbie, but I think most people could assume that that was kind of a one-off in terms of actual going to the theater to see these things, and that you really just need something to really just be in the zeitgeist.
There was Oppenheimer was pretty big.
The concert movies did well too, right?
The concert
Taylor
movie.
did
But
just
again,
fine.
that was in the zeitgeist, and I mean, it was like, I don't know, Marvel is like, look, my guess is Marvel will end up making like a couple $100 million because that's just what it does, right? It'll be a slow burn, and maybe it recoups some of that once it gets to the streaming services. But to get people to go out to a theater on the opening weekends here, look, you got to be Taylor Swift, or you got to be, Barbie, Greta Gerwig, and all those folks, and have something really sizzling to get people out there.
Yeah, I think what I don't know strikes me is this a sort of a one-off in terms of Disney and Marvel, or is this part of something bigger? Because
I don't understand how something did so well. This was the 33rd one, and the best review I saw of this.
Previous ones did so well.
The best review I saw was in the New York Times, where the headline literally said, "You've seen this movie 32 times before."
It does get to start to be, I don't know. Brie Larson, though, in Lessons in Chemistry, unbelievable on Apple TV. Oh, so if you don't want to watch this, go check it out.
It's not a Marvel movie.
I have to put that on my radar.
That's not a Marvel movie?
No.
Yeah.
It's not a Marvel movie.
Did you watch that this weekend?
Yeah, I've been watching it. Yeah.
I saw this great thing on Netflix this weekend about Mr. Chow. It was a great documentary, or on Max, HBO Max, about Mr. Chow, who runs, of course, the restaurants, but just about his career as an actor and artist and everything else. Really good.
I guess I would argue that
since we're giving movie recommendations,
there's a lot of good stuff out on streaming right now. There's a lot of stuff that keeps coming out. So
I've been
rewatching for that already.
Game of Thrones.
Game of Thrones. What about you, Tim? You've got a lot of free time
right
now. Okay.
Tim's like reading books.
No Barney or Wiggles or something.
Just Bluey, nonstop Bluey. That's what we do.
All right, guys, that's a wrap. We're going to come back though in less than an hour's time. Our cross-platform coverage on the markets on this Monday, radio, TV, YouTube, and of course Bloomberg Originals. Join us at 4 p.m. Wall Street time for Beyond the Bell.
We continue our coverage here on The Close, counting you down to those bells, just about 50 minutes to go. And Melissa Brown is joining us, Managing Director of Applied Research over at Axioma. And Melissa, let's talk about just how tepid the price action is right now in the market. I guess a lot of folks are waiting, in fairness, waiting for the latest economic data points. But there's been a broader trend here of a tamp down in volatility, a tamp down in volume for that matter. And I'm wondering at what point do we start to, acknowledge that this maybe isn't healthy?
I think it's not healthy. I'm acknowledging it now.
Yeah.
That I think, you need investors in the market to move stock prices. And we're seeing, as you said, a lot fewer of them, or they're trading a lot less, one or both. And it's keeping volatility down, and it may be driving kind of a false sense of security that, everything is nice and calm and fine, when in fact it's really not, and there's a lot of stuff bubbling under the surface.
That really gets to a broader question about price discovery, and I've been asking people this question all year long as to how reliable it is right now. I mean, pick your asset class here. When you consider the movements that we've gotten and the distortions that we've gotten, how can you be certain about what a good value is these days in the market?
I think that's a great question and you would think that, by now markets would be relatively efficient, but they really aren't. And you've got a whole group of investors looking towards these technology and technology-related names, the so-called Magnificent Seven. I don't know, they're driving those prices up. The money's got to be coming from somewhere, so it's coming from other stocks. And so you have most stocks are underperforming the major indices, and that just doesn't seem right.
And to build on Romaine's question, I mean, when it comes to price discovery and finding the true value for things, how much of a hurdle is it that the fact that you have benchmark treasury yields swinging 50 basis points from one week to the next and trying to actually find that price discovery?
I think there's a whole lot going on there. One is that it's hard to figure out whether bonds are hedged to equities or are they moving in the same direction. The higher that rates go, I think it just makes the decision not so much about the stock price, but about the bond price. And do I want to just be in bonds and have this relatively safe return? And I think that's a huge issue. We have seen money move from stocks to bonds. That may be one reason that overall trading volume is low. There's just fewer players today as compared with, say, a year ago.
Well, I'd love to ask you that question. I mean, when it comes to how you're viewing bonds right now, are they still the portfolio hedge, or are they really a source of alpha given how high yields are?
Well, I think it probably depends on the bond and what area of the bond market you're in. I think high yield is probably relatively attractive right now, and with the risk that it offers, not entirely different from the risk you're getting. And when I say risk, I mean kind of volatility from treasuries. So, certain segments of the bond market are probably attractive. But I mean, for me, I would say, a 5%, 4.5%, 5% yield is pretty attractive and certain, as opposed to the uncertainty of, maybe I would get 6 or 7% in equities.
This gets to the question, though, too, about the Fed's tightening cycle. And we talk about inflation, which is nearing 3%, getting back down to that 3% level, not the 2% level. But when you look at the Fed's funds rate, and even if you adjust on an inflation-adjusted basis here, we're kind of above that level for the most part to a certain extent. And it raises a question as to, A, whether the Fed can just stop right now and not do anything for a while, or whether the market and its sort of fever dream for rate cuts might actually be justifiable.
Well, I would say the fever dream for rate cuts is most likely to be accompanied by a recession, some kind of economic slowdown, which means that, earnings are not going to be good. You're going to have higher unemployment and all of that goes with a recession. So I think if you're in the recession and you're seeing rate cuts, that's probably a good thing. But before you get to the recession, I'm not sure the hope of rate cuts is really going to be justified.
All right, Melissa, it's really great to see you, especially in person. Our thanks to Melissa Brown. She is Managing Director of Applied Research over at Axioma. Now, coming up, investors eagerly awaiting the latest U.S. CPI report. That's coming out tomorrow, and we're going to look at the key points to watch, how it could affect Fed policy.
Plus, a closer look at Boeing, shares of Boeing. It's our stock of the hour, rising on a flurry of orders out of the big event there going on overseas, including a potential deal to sell the 737 MAX to China.
And we'll take a look at why diamond prices have been tumbling and what the world's largest diamond producer is doing about it. All that and more coming up. This is The Close on Bloomberg.
Lowering prices? A bit of a low volume day going on right now in U.S. equity markets as well. A lot of traders, a lot of investors, economists and politicians alike await the latest inflation data coming out of the U.S. government. CPI expected to drop tomorrow morning at 8:30 a.m. Washington time here, and what it says not only about the state and the pace of inflation, but more importantly about the Fed's response is going to be a big determinant of the price action that we see tomorrow. The holding pattern also reflected today in the Treasury space, and you see that right now with what's going on with yields. Your 10-year yield on the far end of the screen, basically unchanged here on the day. A lot of idiosyncratic stories out there to keep an eye on, including Boeing, including Monday.com, and including Tyson Foods. And in fact, across the board, the medical device makers really having a pretty good day. Boston Scientific, Illumina, and quite a few others rising, clawing back some of those losses that had actually been mapped into this market on the back of concerns about how those GLP-1 weight loss drugs would affect those companies. Let's bring Abigail Doolittle into this conversation as we do every day at this time for our Options Insight segment. And Abigail, you're taking a look at stock volatility and bond volatility and how they're saying different things.
Well, this really seems to be the topic du jour. A lot of options folks have been talking to me recently about how the messaging of the MOVE index, the bond volatility index, and the VIX index, or volatility for the S&P 500, well, they just don't match. To talk more about this, let's bring in Josh Silva, managing partner and CIO at Passaic Partners. Great to have you with us, Josh. And so what's the disagreement about? Because we do have the MOVE index relatively elevated, off of its highs, but elevated the VIX back below 15.
So the way I look at it is the VIX is sort of sometimes referred to as a indicator of uncertainty. And it's been very calm this year as the equity markets seem to be thinking there's less uncertainty. The MOVE index is the opposite. It's it's high versus historic averages because there's a lot of uncertainty in the fixed income market. That uncertainty last year came from the Fed. And in fact, the front end of the vol curve for short-term interest rates is very stable, but the back end is very high because we have this uncertainty about supply, about issuance, whether it's corporate or whether it's the Treasury in terms of how much you're going to issue in terms of bonds. So people are waiting to see for that uncertainty to go away until I believe then they will really come back and invest and be comfortable being invested in equities. And
so what will remove that uncertainty, really knowing where rates are going to be over a longer?
Seeing rates stabilized at a level, whether it's 4%, 4.5%, 5%, even 5.5%, I think people will be more comfortable owning equities once they feel that that is stabilized out and we have a certain outcome.
So it sounds as though, if I were going to ask whether the MOVE index or the VIX is correct, it sort of sounds as though, based on your explanation at least, that the MOVE index is correct to have more volatility. I don't know if you, well, do you agree with that?
Well, I think the MOVE index is saying that there's uncertainty. I think equity vol is saying that historical vol, or what I would call realized vol, is less than implied vol, and therefore it pays to sort of sell the VIX. What I think with this, to me, this means is that it's just a much more uncertain market with up and downs where we really don't go anywhere. We're just sort of trading in this upward sloping range led by 7 stocks, as everyone likes to say.
Do you think that a piece of the suppressed VIX that has something to do with going back to rates, if you can get paid 5% or 4.5% or whatever it is for relatively short-term, treasury instrument or money markets or something along those lines, could that be used as a hedge as opposed to the VIX in this uncertain environment?
Yes, and I think that's what happened. I mean, if you looked at what happened with the VIX in the sell-off in October, or for that matter, September or going back to August, we didn't see put buying. And the reason we didn't see put buying is because people are underweight equities, I would say, and in fact own a lot of fixed income paying 5%. In the sense of why would you pay time decay or why would you pay for insurance when you can own a bond that's going to pay you to own insurance? And I think that's what's happening. I think the sell-off is more people putting more fixed income on as we've come off of zero. And there's no need to hedge if you're not overly long or levered long equities.
So we're going into year end, so in about 30 seconds or so, relatively short answer. Do you think that we're going to see a year-end rally? Are managers in a position where they want to try to bring the stock market up?
So I think it seems like that's where it's heading, is because rates seem to be stabilizing out around this 4.5% in the 10-year. Now that can change. I think what's interesting is hedge fund performance has been difficult. If you look at 2018, for instance, when hedge fund performance was difficult, if we have a sell-off, it could become stronger because they're going to do what they need to do to protect their gains. In other words, my sort of final sort of say is if we end up the year up on the year, you probably want to, if we end up higher than here, you probably want to sell it. If we end up lower than here, you probably want to buy it.
Great perspective. Thank you so much for joining us today.
Thank you for having me.
Josh Silva, Managing Partner and CIO over at Passaic Partners. And from New York, this is Options Insight, and this is Bloomberg.
Well, the world's largest diamond producer is doing all it can to respond to plunging prices. De Beers is planning to stockpile these unsold diamonds by allowing its buyers to refuse to purchase all of the stones that they're contracted to buy. Meanwhile, a Russian miner has already canceled all of its sales for 2 months. This is, I gotta admit, Romaine, not something that I had known about. Basically, this surplus of diamonds, this drawdown in diamond demand. What's going on?
Yeah, and this came on my radar. I think it was last week or so, and De Beers had this, they had this big event where all the buyers come to them and they sort of, set the prices and everything. And it's kind of like, you're going to take what we give you. And they basically said to them, look, we're willing to make a lot of concessions this time around because I guess they know that there wasn't really a lot of take up, at least at the prices they were asking for. And I wonder if it's a broader trend here. I mean, I know we blame everything on the younger generations, that they're not buying enough of this and that here. But I mean, there has been a shift in attitudes about, the value of a diamond and whether there are other, type of jewels out there that are, just maybe a little chicer.
And I don't know, you raised the point in the commercial break. Are they actually scarce? Is it that hard to get a hold of a diamond?
Apparently not.
De Beers' CEO said that the company is going to stick to its target of producing up to 33 million carats of rough diamonds this year alone.
It's not that rare. Then you have these whole lab-grown diamonds, which people are saying looks just like the real thing, and everything else. And then there's that trend here where certain generations, they, at least as far as like engagement rings and things where diamonds are usually the star of the show, they're now looking at other type of stones to be the star of the show.
This ties in really well to the conversation we were having about dating apps. People may be using dating apps less. Are they getting married less? You can find that with some of these younger generations moving away.
I thought we went there. Remember years ago when the marriage rate started falling, and then all the diamond producers, they switched, instead of saying you should buy your fiance, they were just targeting straight to women, say you should treat yourself to a diamond ring or diamond necklace or anything else. So I don't know what's next. What's the next fold here?
I don't know.
Maybe they can go after men.
Yeah,
like men who are really vain and just want to like drip in diamonds.
I mean, Skims is doing it, so maybe that's a signal.
Excuse me?
Skims by Kim. They're putting out
a men's light.
Exactly.
Really?
Yeah. So maybe that's there's a page to take from the diamond from Skims.
So does that mean I can finally look like Kim Kardashian?
Yes, you can.
All right.
This is the close on Bloomberg.
This is the countdown to the close. Just about 30 minutes until we get to the end of the trading day here on this Monday, Katie, and it is a very low volume day for U.S. equities.
You could even call it boring. You take a look at the S&P 500 right now. It's pretty much flat on the day, of course, as we await CPI tomorrow. You take a look at the sector level. It's only slightly more interesting. It's pretty much an even split. You look up at the top, you have energy up by about 0.7%, of course, as crude oil rallies. Healthcare also doing well, so too are consumer staples, but pretty small moves in the grand scheme of things. You go down the list, you see what's not doing too well today. Tech off slightly, real estate off by a little bit more, 0.8%, and your big loser on the day, Romaine, is utilities, off by 1.2%.
Yeah, I'm going to go back to the top of the screen there on healthcare because I was trying to find the bright spot here, and you're seeing in a lot of the medical device names, including Boston Scientific, as well as Insulet, Illumina, and quite a few others, and a lot of this had to do with that data that came out of the Novo Nordisk trial on Wegovy that actually showed a decrease in heart-related risk. Why is this a positive for those companies? Well, it did not necessarily show the same positive benefits for diabetes and some of the other conditions that these companies make their money off of. Remember, the sell-off that we had seen in these stocks over the past few weeks was directly related to this idea that we're all on Ozempic and Wegovy and these other drugs, that we wouldn't need insulin and some of the medical devices that pump that into them. At least based on what we know out of these trials right now, that does not appear to be the case, at least in the short term here. You're looking at two of the biggest movers right now in the S&P 500. Meanwhile, keep an eye on the retail space. This is going to be a big week for retail earnings. Tomorrow morning, we're going to hear from Home Depot. We're also going to hear from Aramark. Of course, that's less consumer retail, but you do get a better sense here of some spending when it comes to ballparks, when it comes to concert venues, and even at corporations here. We start to get that nice cross-section of the economy, a nice cross-section of consumer spending. Those earnings out in the morning tomorrow, Katie.
Let's go from the equity market to my favorite place, the world of ETFs. Janus Henderson, it has just launched a new securitized income ETF. Now, this fund focuses on asset-backed securities, CLOs, mortgages, credit, agency, mortgage-backed securities, et cetera. And joining us now to discuss is John Kerschner. He is head of securitized products over at Janus Henderson. And John, I thought this ETF was interesting because you have ETFs for CLOs, for mortgages, et cetera, but this one puts all of them into one fund. What's the logic behind combining them?
Yeah, great question, Katie. And basically, this is our latest offering in securitized ETFs. What I don't think a lot of people understand or realize is just how massive this market is. And I want to break it down for you. The global fixed income public markets are 130 trillion. The U.S. is 40% of that. That's 52 trillion. And then you have the large asset classes of U.S. Treasuries at 25 trillion. Agency mortgages at 9 trillion and corporate credit 9 trillion. You add in 4 trillion of municipals and the remainder is 5 trillion. That's all those asset classes you mentioned, asset backs, commercial mortgage backs, non-agency mortgages and CLOs. And why is this important? Because they are barely represented. Only about 2% of this $5 trillion market is in the Bloomberg Aggregate Fixed Income Index, the biggest index for fixed income in the U.S. So most people are very underrepresented in this marketplace, and yet we are able to build very interesting portfolios with high degree of income and low correlation to other asset classes. That's why we're launching Janus Henderson Securitized Income.
And John, the question I always have when you see a new type of product, an innovative product, is who is this for? And in the case of this ETF, ticker JSI, is this for retail? Is this for professional traders? Who do you envision as the target audience of this fund?
Yeah, it's another good question. It's really for anybody that needs income. What we hear from our investors and their clients is that people are starved for income. Particularly over the last 15 years. Now, obviously, rates have gone up, and that has helped a lot of people get more income into their portfolio, but we still don't think they have enough. Just going out and buying T-bills or getting certificates of deposit, 5%, is still not getting you much more than inflation. With this product, we think we can develop a portfolio, construct a portfolio where you're getting 8.5% type yields, very low interest rate risk or duration, about 2 to 3 years of that. That's about 1/2 to 1/3 of what the AG is giving you. Still very high credit quality. We think it'll be about 75% investment grade rated and very low correlation to other asset classes.
Yeah.
In our mind, that's a winning combination.
John, I'm curious with regards to credit quality, is there a sense that you're going to try to maintain the starting threshold of credit quality, I guess, as, you know, new issues come and old issues need to be pulled out?
Yeah, no, we think, you know, traditionally that in securitized products, they trade wider than what we see in particularly the corporate credit markets. And we think that's going to continue. It's really been the case since COVID hit. And the Federal Reserve did a lot to support the U.S. Treasury markets, the agency MBS markets, and the corporate credit markets, but basically did almost zero for the securitized markets. Add to that the fact that the technicals have not been great in securitized. That just means there's been a lot of supply, more supply than demand, because a lot of money managers, which are big buyers, have been getting withdrawals, and banks have been pulled back as well. So we think that we'll be able to continue building these portfolios to deliver the income that our investors need and want.
What's the approach here to being able to maintain or at least offer some semblance of liquidity, particularly for a lot of assets that, at least on their own, would not be as liquid?
Yeah, I mean, ETFs are very, very liquid. And not only do you have the liquidity of them trading on exchange, but I actually think the underlying securities are much more liquid than people think. Agency mortgages, for example, are the second most liquid market in the fixed income market in the world, behind U.S. Treasuries. CLOs, particularly at the AAA level, I would argue are the third most liquid market. And even ABS and CMBS tend to trade much more frequently than people give them credit for. So we are not concerned about the overall liquidity of this product.
And John, when it comes to Janus Henderson in the ETF market, most people probably know you for JAAA. That is the Janus Henderson AAA CLO ETF. And I mean, the growth has just been off the charts. It's at $4.7 billion in assets under management. You compare that to JBBB, which, as the name implies, of course, tracks BBB rated CLOs. And it really hasn't seen that same sort of intensity of inflows, only at about 133 million in assets under management, despite some outperformance. How do you explain that sort of lack of flows coming into the lower rated product despite the outperformance?
Well, we think it's actually pretty simple. Going into this year, most people were expecting a recession. Obviously, that hasn't come yet, but we also think that growth is slow into 2024. So you want to be very careful with a product like JBBB, understanding how it will perform if the markets do slow down or the economy gets dislocated. And so JAAA is a much easier story. We actually think it's going to reach $5 billion by the end of the year. But JBBB is growing slowly but surely as well. It took in 22 million last year. We continue to spread the word. I just think people want to see a little bit more of a track record and how it performs in different markets. But we think it'll get there and be several hundred billion by the end of next year.
All right, John, it's really great to chat with you. That is John Kerschner. He is head of securitized products over at Janus Henderson. Now coming up, the season of strikes continues after the Starbucks union baristas announced their biggest strike yet. Shares lower on the day. We'll have the details next. This is The Close on Bloomberg.
All right, the summer might be over, but the strikes continue. This time, we're talking about Starbucks. Thousands of union workers announcing their biggest strike yet at the coffee company, set to take place this Thursday. Hundreds of sites could be impacted by this one-day work stoppage. Josh Edelson has been covering the labor market for us and some of the strikes that have been going on all year long for us here at Bloomberg. And Josh, let's start off here and give us some context here. We're talking about unionized workers here. I thought unions had a relatively small presence among the Starbucks workers.
Up until a couple years ago, there were no unionized corporate-owned Starbucks in the United States. Now there are more than 350. This has been, in some ways, the most stunning of a series of stunning union organizing successes at prominent U.S. companies over the past couple years, coming out of the depths of the pandemic. That said, most Starbucks stores in the U.S. are still non-union, and the unionized stores none of them has come close to actually reaching a union contract with the company. And that issue and the union's claim, which Starbucks denies, that Starbucks is refusing to negotiate fairly, is why there's now this strike. The U.S. Labor Board has accused Starbucks of failing to negotiate fairly, but has a very long process and limited penalties when it thinks a company is breaking the law.
Yeah.
And so the union has sought tactics to keep the pressure up on Starbucks and try to get the company to change.
I'm curious as specifically what they've been asking for in the negotiations, or at least the negotiations that would come. I mean, it was pretty clear cut what we saw with UPS workers, with UAW workers here. But for Starbucks workers, this is more than just about pay.
That's right. One of the major issues has been staffing. And in fact, the union has proposed that when a store is understaffed, if you have, say, 2 people doing 3 people's jobs, those 2 people should get the pay that the 3 people would have gotten. The union has also made more ambitious, unusual demands, like having worker representation on Starbucks corporate boards, something that would be much more common in Europe, but is rare in the United States. The workers say they want a seat at the table, and they draw on the symbolic message that Howard Schultz had as the company founder and CEO, when he said that there was an empty chair at the table for the worker. The union is saying that should be filled with an actual representative of the Starbucks workforce.
And so, Josh, the strike that's potentially approaching in 3 days' time, it's a one-day strike. But, I mean, as you walked us through, this is a long-standing issue. Are these one-day strikes potentially longer, something that we should expect to see more of as this issue drags on?
Yes, this is something the union has done repeatedly. They say this one will be the biggest, with thousands of people participating. And it's reasonable to expect that there will continue to be work stoppages like this, as well as other forms of pressure, like students pushing to get Starbucks kicked off campus if there isn't some kind of peace that emerges between the company and the union. And any kind of peace agreement at this point still seems far away.
All right, Josh Edelson here, all over the big story here that unionized workers at Starbucks plan a work stoppage on November 16th. That's this Thursday here in the U.S., coinciding with the company's popular Red Cup promotional day. Meanwhile, back to the broader markets here as we count you down to the closing bells. Mo Haghbin, head of solutions over at Invesco, going to be stopping by the big program as we count you down to those bells. Katie, a somewhat tepid price action right now in broader markets.
Tepid price action, really low volume, down 21% from the 20-day average. This is Bloomberg.
This is the countdown to the close. I'm Romaine Bostick alongside Katie Greifeld. And Katie, we keep saying the price action has been somewhat tepid. We talk about volume being very light here. And I guess maybe the catalyst that brings the volume and the volatility back are going to be some of the economic reports we get this week.
Yeah, we got a lot to look forward to at 8:30 a.m. tomorrow with, of course, October CPI numbers. But I know that we're in this holding pattern until we get them. But are they really going to clear anything up?
Probably not.
Yeah.
I think in some people's heads it might actually sort of give that clarity. But I think you're right. It's going to be hard to really see, wow, that one report is really going to change the narrative, particularly when you look at economist estimates, which show that still the inflation rate's still going to be at 3% or higher.
Absolutely. But even still, I mean, you look at the market right now, it's not much to talk about. When you look at the S&P 500, you are seeing more movement under the surface. I believe that's oil and gas producers that are having an okay day today.
This goes to the question, though, too, of kind of what people are buying and just the competition for return and for yield. I mean, even we were talking a little bit earlier with folks over at Janus Henderson about the new ETF and the idea that people are sort of starved for that. And I was looking at the earnings premium on the S&P 500, which I don't know if you remember, but just a couple of weeks ago, I think it was like October 19th, it actually narrowed down to the smallest gap that we've seen since 2002. That's basically the gap between the earnings yield on the S&P versus what you get in benchmark 10-year treasuries. And you can see just how low it is right now just on that basis, but it is starting to creep back up just ever so slightly.
And this is really, I mean, a direction of travel story. When it actually flips into negative territory, does it actually matter? But you can see it's sort of hovering around those very low levels. And that's what we've been talking about all year, the fact that bonds actually earn something right now. Do you want to bother with the stock market?
Yeah, it's a good question here, particularly on a risk-adjusted basis. Let's ask our next guest that question. Mo Haghbin joining us right now. He's head of solutions over at Invesco, joining us to help count down to those closing bells, which are just about 8 minutes away. And Mo, let's talk about the competition here for returns. I mean, let's face it, 2 or 3 years ago, the equity market was really the only place you were going to get a meaningful return. That's not the case anymore.
I agree. Well, thanks for having me, Romaine and Katie. You're absolutely right. We do see elevated cash positions across most portfolios, whether you're talking about large institutional asset owners or even high net worth investors. And I think what's important to note is that even though we have elevated yields on the short end of the curve, it is actually a pretty favorable time for risk assets. If you kind of look at where we started the year, most people would have expected a pretty challenging year for equity markets. Growth was projected to slow. We were actually even forecasting a recession. Fast forward to now, I think the economy has been incredibly resilient, both in the U.S. and even abroad in places like Japan. And our leading economic indicators are actually pointing to, pretty healthy and stable cyclical parts of the economy. So thinking about the labor markets, manufacturing, the housing markets, all very resilient. And even risk sentiment is starting to improve. So I would actually argue that it's time to think about extending your duration, especially with the Fed starting to be done with the tightening cycle and with equities continuing to show a very attractive return over cash. I mean, S&P up 16% for the year. Even on a full year basis, cash is about 5%.
That gets to the question, though, too, that if there are folks on the sidelines who maybe do see what you see here, Mo, is the sense that we'll see some of that broaden out a little bit. The idea that that money flowing in isn't just going to go to the Microsofts and NVIDIAs and the other sort of big cap tech stocks that led the rally at the start of the year.
Yeah, Romaine, I'm glad you brought this up, right? Because we see a very narrow and very concentrated equity market, especially in the U.S. When you compare the U.S. equity market, historically, these levels of concentration have been unprecedented. They actually have been very mean reverting in history. And the U.S. equity market relative to developed markets outside the U.S. and even emerging markets, we see that narrow leadership, that tech leadership. If the economy is stronger and more resilient than we expected coming into the year, we do expect to see that broadening out. So think about small and mid-cap stocks, value-oriented companies, sectors like financials, industrials, materials, energy to lead the way.
Well, that's an important ingredient to that broadening out, the fact that the economy has to hold up and maybe get better. And with that in mind, I mean, is tech sort of your all-weather sector?
Well, so tech historically has been, very defensive. If you think about tech from an exposure standpoint, it tends to have a bit more sensitivity to interest rates. So over the last few years, it's done quite well in a defensive portfolio. But if the economy is stronger than expected, if risk appetite continues to accelerate, you're really thinking about more value names, more small and mid-cap companies, and even international and emerging market equities, which have been really underperformers in the last part of the cycle, but could lead the way out, especially as the dollar weakens.
And I mean, you talk about small caps. I have the Russell 2000 pulled up in front of me. It just feels like small caps in particular, they just can't catch a sustainable break. And you talk about how maybe they could lead the way out of this next cycle. And Mo, looking at recent history, it seems like a big if.
It's definitely been challenging. Even value, if you think about the value versus growth spread, we're really at historical wides. What I would say is thinking about periods in history where we've seen these types of deviations or deltas, there has been a mean reversion effect, right? So from a portfolio standpoint, if you think about how to diversify a portfolio, now is the time to really think about your allocations across the regional equity block. Think about where you have overconcentration. And as the markets have, been very, very strong in certain parts of equities, have you kind of adjusted or rebalanced the portfolio back to your strategic asset allocation or your target weights?
So this gets to a question then. Do you think that we're going to start to see a lot of that happening before the year end, or do we have to kind of wait? I mean, and I'm just looking at it more from a broad market perspective as to what to expect when it comes to money flows, as well as volume and volatility. Or do we think this is going to be something that we're going to have to wait till the start of the year to see?
Yeah, great question. I think over the next couple of quarters, Romaine, you should still see a pretty favorable environment for risk assets. So we are positioned a bit more pro-cyclically, again, kind of dropping down in the market cap, getting valuation back into the portfolio as growth has run very, very strongly over the last few years. So the next few quarters, I think, will be actually pretty favorable. That said, we should see a growth slowdown in the first half of next year. And if we do see that, then there will be some activity on the rate side. And the cycle really hasn't started anew. I would still say we're late stages of the business cycle, and we're really looking for a meaningful kind of entry point. If you're kind of thinking long term, you could argue that there's going to be opportunities in the horizon as well.
All right, Mo, great to catch up with you. Mo Haghbin there over at Invesco, the head of solutions, helping us count down to those closing bells here, Katie, on a Monday afternoon where volume remains light as everyone now waiting for that CPI report.
You could say it fell off a cliff. I mean, you look at the S&P 500 right now, volume is 21% lower than the 20-day average. So again, a holding pattern, but as we've been discussing, I don't know if tomorrow will necessarily bring much clarity.
You're seeing similar tepidness in the price action across other asset classes. Stick with us. Full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with Carol Masser and Tim Stenovic. Welcome to our audiences across our Bloomberg platforms here on a Monday afternoon, Carol Masser, where it looks like a lot of people have decided to sit this one out.
Where is everybody, right? I mean, bring on the economic data, bring on the inflation reads, bring on the retail sales numbers, bring on the retailers reporting, bring on even Fed speak, right? We need something to kind of move this market a little bit.
No Fed speak.
No Fed speak.
We love Fed speak. It gives us something to talk about. It gives us, it gives the strategists ammunition to kind of figure out where they're going.
Right,
with
those year-ahead outlooks.
Exactly. That's important stuff. You do make a good point, though. Sort of everyone's just kind of waiting around for economic data this week, and perhaps the other earnings that we still are in earnings season. We got some big retailers reporting, Walmart on Thursday. We got Home Depot tomorrow. So there could be some catalysts out there, Katie.
We're still in earnings season because earnings season never ends. And it will be interesting to hear from some of the big retailers. Romaine and I have just been chatting about, though, we're going to get some of these retailers. We're going to get CPI, of course, tomorrow at 8:30 a.m. And we're going to parse that data to death. And whether or not we actually get a meaningful signal from it, whether that changes the conversation around December remains to be seen.
Yeah, I mean, look, when you look at sort of what the economists are projecting, we're talking, 3.3% year over year here, 0.3 on a month-to-month basis here, and that's relatively in line with where we've been now for the last couple of months. So I'm not sure if those numbers get hit right on the nose. I'm not sure it really changes the narrative at all. All right, we're getting the closing bells here in New York on this Monday afternoon here, and once again, a low-volume day leading to what is a relatively unchanged market. The Dow Jones Industrial Average is in the green on the day, but only by about 0.1%, higher by roughly 49 points and change as we wait for these numbers to settle. The S&P 500 lower by about 3 to 4 points, or about 0.1%, while the Nasdaq Composite is going to finish the day lower by roughly 30 points, or about 0.2%. And the Russell 2000 really emblematic here of just how tepid the price action was, unchanged on the day at 17,000 and change.
All right, so tepid on the price action. You look at the S&P, little changed here, lower. If you dig a little bit deeper, though, a little bit of a negative tone in terms of the individual names. 307 to the downside, losing some ground in the Monday trade. Katie, 194 to the downside. So a little bit of a, like I said, a negative slant to unchanged in today's trade.
Yeah, and you take a look at some of the industry groups. There's a lot of green, a lot of red, so it all washes out to about neutral. But you take a look at what did well today, and it's the autos group. But we know a lot of that is coming from Tesla, but nonetheless, that group higher by about 3.6%. Healthcare equipment and services also having a good day. So too is energy. So those are your bright spots. You take a look at the bottom of the list. What isn't doing too well today from an industry group perspective, you have retail, real estate, you have tech hardware, and you have utilities leading losses down by about 1.3%.
All right, so let's get to some of the individual gainers. Some winning really big time on company-specific news. Boeing just finishing up the day with about a 4% gain in today's session. We know what's going on. Rallying. China considering ending a long commercial freeze in what is a critical overseas market for Boeing specifically. So maybe making an offer. We'll see what happens out of those meetings with President Xi and President Biden in San Francisco on Wednesday. Then the company also getting a major jet deal, $52 billion commitment from Emirates. So that certainly gave a boost to that name. fascinating, right? We talked about the news from Novo Nordisk when it comes to its diet drug, essentially, or really diabetes drug, but also very effective when it comes to weight loss, this new class. But at the same time, you had this whole class of companies that benefit. I'm looking at Dexcom, continuing to move higher, up another 4.6%. They make glucose monitoring devices. And then you had DaVita, which is kidney dialysis companies and centers, operates those centers. It was up about 6.5%. So what's interesting is that maybe the oversold aspect of these names, because maybe the findings from this latest drug study, if you will, that maybe potentially there isn't a ton of new news. There's more to be studied. We still have questions about insurance coverage for these very expensive drugs. So nonetheless, I thought it was interesting that these other kind of companies that have been hurt as a result of these drugs actually rallied in today's session. Sorry, I'm having a Monday brain. And then you got Tesla. You mentioned Tesla earlier, up about 4.2% today's session. Top of the NASDAQ 100. India considering tax cuts on EV imports for up to 5 years. And then Tesla, I also saw a deal expanding its supercharger network with a major gas station operator. So this is the second major deal that they've done in a few weeks. So anyway.
A gas station operator. I've always been confused by that.
Group.
Yeah, I've always been confused as to why you don't see more of these charging stations at a gas station.
I agree. Like, it would be just make sense, right? I mean, make people stop. And actually, if you've got a store, you'd probably go in and eat some more food and stuff. Like, I don't know.
That's a good business idea, Romaine.
Maybe starting to come.
We'll get cracking on the business plan after this. I guess I don't know why that isn't a thing, though. Actually,
who cut Tim into this deal?
Good point. We were all there when the idea happened. Okay, this is the beginning of the lawsuit.
I know this is the beginning of every founder's lawsuit.
Okay, let's go to Tyson Foods. A few notable decliners today. I did manage to find some stocks that actually moved lower than the averages. Tyson Foods shares falling 2.8% on the day today. The company did provide a weaker than expected fiscal 2024 revenue. Also, adjusted operating income forecasts reported mixed quarterly results as well. Our own BI analyst called the company's forecast, quote, conservative, though the company increased its quarterly dividend. Starbucks shares, I want to take a look at where Starbucks shares ended the day. We saw the redhead just before 3 o'clock today that unionized Starbucks baristas plan to hold their biggest strike yet this week, accusing the coffee giant of refusing to fairly negotiate at cafes that voted to organize. Shares of Starbucks falling 0.8%. So in terms of numbers here, thousands of employees at hundreds of different Starbucks will have a one-day strike this Thursday. That's according to the union Starbucks Workers United. And then finally, this is a really interesting one. Golden Heaven Group Holdings. It's a company that has amusement parks, water parks, recreation facilities in China. Nate Anderson's Hindenburg research came out today and said the company is short Golden Heaven Group. Shares fell close to 28% today. The company did not immediately respond to a Bloomberg News request for comment, which was requested outside of normal business hours. We should note that Hindenburg has gone after Block, Nikola, Adani, Icon Enterprises, among others.
Okay, that's a new one for me. Golden Heaven Group sounds like something Carol would have there. Let's check in on the yield space here. Not a whole lot exciting what's happening there. We did see yields basically shift just a little bit lower here across the curve, but as you can see here, the shift relatively modest, about 3 basis points on the more Fed-sensitive 2-year yield, but only about 1 to 2 basis points on the other parts of the curve. And I was just taking a look too at just the oscillations between sort of the low intraday low on the day and the intraday high on the day, and this is actually one of the least volatile days that we've had in about a month here. And in fact, it really tracks well below the average that we've had on a year-to-date basis with regards to the point swings that we've seen on treasuries. And I guess that really is a reflection of the data that we're going to get over the next couple days. CPI data on Tuesday morning, PPI on Wednesday morning. And the one I'm looking forward to really as the official retail sales data to really get a sense here of just how much the consumer is holding up.
Yeah, a lot to parse through. And, again, maybe it won't wholesale change the narrative, but it'll be important clues as to how the consumer is faring, how this economy overall is faring. And you think about some of those most dire cut forecasts for next year. I mean, these are important components.
Well, and, we talk about, obviously, how important the consumer is to the economy. Like, at some point, you do wonder, is the household balance sheet, has it come down? They're potentially putting more on credit cards, paying higher fees. on those credit cards. And then you think about the student loan repayments. Like, I am waiting for more significant signs of the consumer cracking. I feel like we see it a little bit. If you got an auto loan, that's become really expensive. So I agree with you. That retail sales number, if we start to see some real dramatic trend lines to the downside, that would be significant.
Did you see the column that Betsy Stevenson wrote? She was a former labor economist, works at the University of Michigan now, and she had a Bloomberg opinion column where she was kind of going through the various scenarios of why there's this disconnect between the relative health of the economy.
Oh, is this where you're like anger or something?
Yeah, and the idea that people on the ground really are still upset about the economy. Now, she said some of this is just politics, and there are a lot of people that don't really believe the nonsense that's coming out of their mouth. But there are other people, too, that are still looking at prices that are elevated. Yes, they've come down, but they're still higher than what you were paying a couple of years ago.
I can't remember who said this recently, but they're like, okay, inflation has come down, but prices have not. And I was talking to a CEO about this recently. I'm like, help me understand, are your costs still higher? And I just don't understand.
But maybe it's a misconception with how Americans understand inflation. It's not that prices are going to actually come down. It's that prices are going to accelerate at a rate that is less than they previously accelerated.
Yeah, but people don't think like that.
They don't. I think the big problem is because of gas stations. We go back to gas stations, truly, because the price of a tank of gas has remained so constant, Romaine, over the course of many people's lifetimes at the gas pump that they think, okay, well, gas prices are high now because it was 2 years ago when Russia invaded Ukraine, and then they come back. So maybe people think that's the way inflation works.
But also, just back to your point, though, about how people kind of conflate what inflation really is. And I think that was really Betsy Stevenson's point, which is that economists look at inflation and these growth rates, and that's what they focus on. But the consumers really focus on the absolute price.
Yeah.
And it makes sense, right? I mean, because that's whether you're going to a gas station or a grocery store or buying a movie ticket or concert ticket, you just look at that absolute price, and that's the thing you react to. Whether that's come down or whether the growth rate is slowed on that is almost immaterial to the average person.
Yeah, absolutely. It's kind of sticker shock, right? When you see the numbers, and it really impacts you.
I just bought a concert ticket the other day. It was a lot.
Who are you going to go see?
I don't even want to tell you. I'm actually chaperoning my son to some little rapper.
I actually know the.
Who is it?
Make sure he doesn't get killed while he's out there or something.
I'm sure it's actually someone really cool who I've never heard of.
I'm sure they are. They're pretty cool if you're like under the age of 20.
You're on TikTok.
But I'll be sitting a few rows back with binoculars, keep an eye on him.
Not get killed.
I kind of want to go sit behind you, Romaine, and just watch you.
We want pictures. All we know is we want pictures because I've seen you move to some music, and it.
Yeah, I have my taste, but like every person, you always think the younger generation's music is absolute trash. So.
All right. Anyway, Romaine's doing some shopping. Maybe that's an indicator of like what's going on with retail sales. We'll find out.
It's forced shopping.
All right, forced shopping.
That's taking money out of my Christmas budget for you, Carol.
Hey, wait, we got to talk about this. All right, we will continue this tomorrow, guys. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will see you again tomorrow.
And we continue our coverage right here on Bloomberg Television. Coming up, we're going to talk about higher yields and how they may mean more money in the pockets of retirees. It's an interesting story, and you don't want to miss it. That's coming up next on The Close, right here on Bloomberg. Here on this Monday afternoon, looking at one of the lowest volume days that we've had in U.S. equity markets in more than a month here. The net effect of it was, well, all the major indices relatively unchanged here on the day. A little bit of a holding pattern ahead, what's going to be a busy week for economic data as well as some key earnings out of several retailers. The NASDAQ 100 was among the biggest laggers, down about 0.3%, but the Magnificent Seven did exactly what they're supposed to do, and that is rise. They rose all together as a group, but of course some of the individual names were still on the back foot here as other individual stories really started to take a bit of the spotlight. That includes the medical device makers like DaVita, as well as Boston Scientific, which had big rallies on the day. Monday.com, big software company, also having a big day as well on the back of some interesting guidance. Meanwhile, the setup going into some of those retail earnings I was talking about, not necessarily all that bullish. Remember, the retail sales report, the government data itself is coming out midweek, and sort of couched around that is going to be Home Depot earnings, which we're going to get tomorrow morning. You're also going to get get earnings out of a lot of other names, including TJX, Macy's as well. You see what's on the back foot, and that's largely because of concerns here that consumer sentiment has really shifted. We know that consumers weren't buying a lot of goods anymore in favor of services, but now there is some concern here that that is going to spill over into services. Of course, that is the backdrop for a big CPI report scheduled to drop tomorrow morning, and inflation expectations, believe it or not, by some measures are actually coming down. If you go by the latest New York Fed survey, which came out this morning, that trend line is down. That's the yellow line there. But the blue line that you see on your screen, that's the University of Michigan sentiment data. And that's going up here. The white line, that's the official CPI data. And you can see it's sort of splitting the difference there. It'll be interesting to see what happens tomorrow morning.
Well, let's switch gears here before we get those figures, because in a sense, retirees, they just got a raise. That's according to Morningstar, which says that the percentage that a retiree can safely withdraw from savings over the 30-year outlook with a strong chance of not running out of money, well, that just got bigger. Joining us now to explain is Bloomberg's Craig Giammano. And it's not a huge raise, but it's still something.
Yep, bumped up a little bit from last year. They're basically saying because of their forecasts for more modest long-term inflation, better bond yields, that they gave a little bit of a bump to the percentage that that retirees can pull out of their savings on an annual basis. So a little bit of a raise.
And so let's talk about some of that math there. So if you have a starting balance of $1 million, 4% rate means you can safely pull out $40,000 a year. Of course, that is going to increase each year when you account for inflation. Talk to us, though, about what theoretically is in this mix. You mentioned bonds, but it seems like it's not exactly a 60-40 sort of mix.
It's not. They're basing it on somebody who's much heavier in bonds. So this is, in theory, a retired person who's shifting to something safer, that's looking for stable returns. The numbers change a little bit for a portfolio that's heavier in stocks. I think it goes down to 3 and change, if you're 75% in stocks. But like I said, this is basically a sort of higher for longer. We're going to see better yields and inflation coming down, so a little bit more money. A lot of this depends, obviously, on how long you're going to live. I mean, that's the backdrop to all of this. People are living a lot longer. Medical expenses are, a big deal for a lot of people. So that's, I think, a big reason why this is such a stressful topic for people.
It's a stressful topic, but like I said, I mean, this does end up being the silver lining, right? If you are of a certain age here, it makes sense to lock in some of these rates as well. And the idea, too, I thought Morningstar highlighting this idea that spending typically tends to go down the older you get. You're not buying a lot of discretionary items in the way that somebody like Katie is. I mean, she was shopping for diamonds earlier on the show.
Fewer Taylor Swift tickets amongst this crowd, you would think, things like that, dinners out. So the spending does go down. I mean, it is one of the sort of silver linings of inflation, right? It's been a lot better for savers. You can get 4.5 in a high yield savings account, and bonds are doing better. So this is good news in theory for the retiree.
And of course, the backdrop is also against inflation, right? The idea, I mean, if you had this conversation even a year ago, I mean, you could have made a case that maybe some of those bonds were kind of a bad deal because rates were still tracking well below where inflation was at the time. But now that inflation has gotten back down to, 4-ish, 3.5-ish%, wherever it is right now here, you can maybe make an argument that those yields now are even more attractive.
Yeah, that's right. And I mean, I'm sure these people are still, when they go to the grocery store, saying, wow, this bill is a lot more than I paid. We all have that sense, right, that things are still more expensive. But I think to your point, less of the discretionary spending that's really slamming us, plane tickets, hotels, concerts, experiences, things like that, less of that. So that's why this is the silver lining.
And Craig, we're talking about a 4% rate, but how does this usually work? Do retirees, when they're thinking about 30 years, do they typically withdraw the same percent every year? What does Morningstar have to say about that?
It's typically sort of the advice. I think a way to get your mind around how this all works is to set. I mean, I think that they're creating a basis for an argument here. So I'm assuming it varies. There's obviously, like I said, medical expenses, things come up where you have to take out more. I think they're just sort of setting a base case and saying, if you had $1 million, 4% would basically get you to 30 years without running out of money.
There's a broader question here that Morningstar didn't really address directly, and you may not be able to answer it either, but there has been some concern that as we get this generational shift with the most populous generation, the baby boomers, passing on, moving on here, that there's this idea that you won't see the same investment levels in equities that you maybe saw over the past few years, simply because you just have this critical mass of people who are at a retirement age where at least traditionally you're expected to reduce your exposure to equities.
Yeah, that's a great point. I don't know the specific answer. I mean, I think when you read about Social Security, it gets scary. I mean, they're talking about now 2033 without major changes, that you start to see benefit cuts, and whether this generation is going to invest in that same way, follow that advice. I mean, that is a major concern. This is the generation that sort of did that. They own stocks. They own their houses, at least one, maybe multiple houses. So I think the other reason why this is so stressful for people is people under 40, even under 30, are just looking out at the economy and saying, how am I going to get to this place? When you say to someone, oh, you have $1 million saved for retirement, a lot of people under 40 have a hard time imagining how that's ever going to happen.
All right. Well, that's a sad note to end it on, but great reporting as always. Craig Giammona, who leads our coverage here on what's going on in the world of personal finance. Meanwhile, we want to go back to what's been happening with regards to inflation and the big CPI report tomorrow. A change in the calculations in CPI could actually boost inflation in one category in particular. We're going to discuss that coming up after the break. This is Bloomberg. All right, a new change in how the government estimates health insurance costs could actually give a boost to the Consumer Price Index report, which comes out tomorrow. Joining us now to talk a little bit more about this is Bloomberg U.S. economy reporter Matt Boesler. And Matt, all right, I guess we're going to get in the weeds here about methodology and all that. But explain this for me. Why all of a sudden are we going to see this big jump up in healthcare costs simply because of a calculation change?
Yeah, so basically the BLS has decided that it's very difficult to measure prices of health insurance. And so typically everything in the Consumer Price Index is trying to measure the costs that are paid out of pocket by consumers for various goods and services. But with health insurance, they basically decided to calculate it a different way based on health insurers' retained earnings. And so basically when health insurance companies' profits go up, that is kind of measured in the CPI as an increase in health insurance prices. Now, they only get these retained earnings data once a year based on the way that they're calculating it right now. And so there's a bit of a kind of lag to, when this filters into the data. And then also, there's kind of like a steady predictability going forward for the next year.
Well, sorry, just to stop you there for a second. So the switch is to retained, or to a closer look at retained earnings, right? So what were they doing before? It was based on us, on our spending, or it was coming out of the corporate balance sheets themselves?
Well, so they've been doing this retained earnings method for a while. The switch that is going to take effect in tomorrow's CPI is that they're going to start looking at this on a semi-annual basis instead of an annual basis.
Okay.
And they're also going to try to kind of take more of a moving average approach to it instead of, just looking at these discrete, once a year or once every 6 months data points. And so, that should lead to a little bit more predictability in what the data look like.
And Matt, not to be pessimistic or nihilistic, whatever you want to call it, I mean, reading this story and listening to you talk, it just makes me think that, nothing really matters except the lived experience of inflation. Because if you think about the methodology changes, how that could actually filter in through the numbers, I mean, this is not something that average Americans actually think about.
No, it's not. But I think what we've seen, over the last several years is that, these monthly numbers really play heavily into the, political narrative around this, and certainly the central bank narrative, right? So Fed officials watch these data very closely. Investors obviously do as well for the same reason. And so this is something that is important for investors to understand when they're reading the numbers tomorrow, because it's going to push, the overall inflation numbers up a little bit. And it's worth noting that this is, more of a technical change than, like you say, something that is changing in the kind of underlying lived experience of Americans.
And when you think about calculating inflation, what a difficult job that is. And of course, this change coming tomorrow really illustrates that. I mean, what would be the hardest category for some of these government agencies to calculate? We spend a lot of time talking about housing and shelter costs, for example. I didn't even know that health insurance was also extremely difficult to calculate.
Yeah, it's definitely up there. And I think, kind of a related question is, about which ones are hardest to predict, right? And so we're in a situation now where we had really nice slow inflation prints over the summer. They're kind of picking back up again. And a lot of that has to do with a lot of these categories that do move around a whole lot and are very hard to predict, like airfares, like hotel rates. And so those are some of the things that are going to be in play tomorrow. Some of the reasons why, many forecasters are calling for a 0.3 increase, which is higher than we've seen in past months, but are also warning that it could be as much as 0.4 increase due to upside risk in some of these volatile categories.
And this raises a question, too, for those market participants who are really trying to gauge where inflation really is here. Does CPI still represent the best metric, or should we be looking more at some of the other data that the Fed looks at?
So the Fed certainly cares more about the PCE metric. I think the big problem with that is that CPI comes out mid-month. PCE doesn't come out until the end of the month. So CPI is always the first look we get at the monthly inflation figures. And it kind of leaves us hanging for that 2-week period in between the two reports where, this is what we have to go on in terms of what the latest inflation numbers are. So even though the Fed cares a lot more about PCE, this is certainly something that's potentially going to set the tone in markets for the next 2 weeks.
Absolutely. And you think about all the focus being placed at 8:30 a.m. tomorrow. I mean, how dramatic would the miss to the upside or the surprise, whatever you want to call it, have to be to actually change the needle for the Fed when we think about December's meeting?
Yeah, so I think it would have to be fairly dramatic because if you look at, where futures are at the moment, they're pricing a very small chance of an increase at the December meeting. I think the last time I checked, it was around 15% earlier today. So this is just, a really high bar to hikes at this point. The maybe more interesting question is, does January come into play a little bit more? The Fed maybe takes a pause for one more meeting, and then we start to see that case building for another hike in January. That's something to keep an eye on.
All right, Matt Bosler, who covers this for us here at Bloomberg. A look at one of the key nuggets that we're going to look for tomorrow in that CPI report here. Remember, the expectations among economists surveyed by Bloomberg, 3.3 on the headline number year over year, 0.3 month to month. All right. Coming up here, we're going to do a deeper dive into the retail side of our economy. Retail earnings from Home Depot and quite a few others set to drop this week. Jharonne Martis is going to be joining us of the London Stock Exchange Group to tell us about the trends that she's been watching. That conversation coming up next on The Close. This is Bloomberg. A relatively tepid day across all the asset classes here in the U.S. The S&P 500, the Dow, the NASDAQ, as well as the Russell 2000, all relatively unchanged here on the day. And when you go across other asset classes where you're talking about the FX space, what we saw in treasuries, you're also seeing a somewhat subdued market picture here. That's really the setup heading into what is going to be a critical week for a lot of key economic data points, including tomorrow with the big inflation report, and a little bit later in the week when we get the official retail sales numbers out of the government. But of course, in the middle of all that, we're also going to get a lot of numbers, a lot of earnings coming out of some of the retailers themselves. That includes names like Macy's. That includes names like TJX. And it also includes, Katie, names like Home Depot.
And Home Depot, of course, kicking us off before the bell tomorrow with earnings. And joining us now to discuss is Jharonne Martis. She is Director of Consumer Research for the London Stock Exchange Group. And of course, heading into tomorrow's report, I mean, sentiment is pretty grim. You take a look, Home Depot expected to report a fourth consecutive comp sales decline in the latest quarter. Should sentiment be as bad as it is right now?
Well, in general, the home improvement and the home furniture sectors have been on the decline in terms of earnings estimates being revised downwards. Analysts polled by LSEG have been more bearish on these sectors, especially after 2 strong years boosted by the pandemic sales. On top of that, you have a consumer that has shifted their spending more towards services and is being very picky in terms of pricing. So all these factors combined with a weak housing market, housing sales are weak, housing affordability has hit a 40-year low. All these things combined have caused for the home improvement sector and home furniture sector to be down. In fact, they are expected to post not only negative same-store sales in the bottom top 10, but also revenue is expected to be down at Home Depot 3.3 compared to a year ago. And also Lowe's is expected to see a decline in revenue for 11.1%. So in general, these groups are expected to be in the bottom performers this earnings season and also for the next earnings season for the holiday quarter.
Well, Jharonne, you mentioned those 2 really strong years, of course, in the pandemic and coming out of the pandemic. And when you think about the situation that Home Depot and some of its peers have found itself in that industry, I mean, is this normalization or have we tipped into true weakness for this group?
It's more normalization, and definitely the housing market in itself has its own issues. It's not an overall consumer issue, given that consumers did go out last month. The U.S. government retail sales tells us that the consumers went out and bought big ticket items like cars. That's what they splurged on. And then also we're seeing some pockets where the consumers are spending. They're not spending all throughout the sectors, but certainly there's certain groups. Like, for example, the high-end consumer still wants designer clothing, but for less. As a result, TJX is expected to be a big winner this earnings season. Then you have the teen retailers, right? Abercrombie & Fitch is on track to post its second strong quarter of double-digit same-store sales. And this is telling us that parents are not frowning so much when their kids are spending $100 on a pair of jeans at Abercrombie & Fitch. So as you can see, the consumer is feeling okay about extending themselves, but only in certain areas. And this is the first sign that the first quarter that we're starting to see the consumer spend a little bit more freely compared to previous other quarters.
Well, I'm curious, like, who benefits over the short term here? I mean, are we talking about, I guess, more of the targeted retailers, meaning those that have a very specific niche, or more of a department store and more to the broad-based retailers, you know, like, I don't know, a Kohl's or a Macy's, Ross Stores?
When we look at the long term, the prevalent winners, that's definitely Walmart. Walmart is the big one, the one that analysts are the most bullish on this week. In fact, the analysts are betting that Walmart is likely to beat earnings estimate and post a positive surprise this week. And this is mainly groceries is still good. Consumers still want everyday low prices. And as a result, Walmart has been able to gain more market share. On top of that, Black Friday is around the corner, and they've done a great job in informing consumers that their Black Friday deals start on Wednesday because of their new ad. The new ad that is with the actors from Mean Girls, and it's been a big hit. Even consumers that don't shop at Walmart know that Walmart has Black Friday deals on Wednesday. But other than Walmart, Lululemon continues to be a very strong winner. Ulta will be a strong winner for the holiday season, and then Abercrombie & Fitch is on track to be a favorite for the teen retailers. Yeah, interesting. I actually bought my first Lululemon thing. It was a nice little shirt. I used it for golfing. It was actually worked out pretty well. I am curious though. We're going to get Williams-Sonoma, and they kind of seem like an outlier. I mean, I normally love this company, particularly this time of year, because they put out the completely ridiculous catalog with all this crap that nobody really needs. And I am curious as to how they hold up in this environment, because so much of what they sell, I know some of it is more necessity, but a lot of what they sell is sort of the ultimate discretionary of items. Correct. And so Williams-Sonoma being part of that home furniture sector, they're also taking a hit. They're expected to be in the bottom 10 performers in terms of same-store sales for the third quarter. However, that is still expected to pick up and perform a little bit better during the fourth quarter during the holiday season. It continues to be a favorite. Those holiday special gadgets that they sell for cookware are still a favorite amongst the high-end consumer. And therefore, they will see an improvement during the fourth quarter. But for this particular quarter, when they report, we're expected to see same-store sales down, mainly because they were a pandemic, one of the pandemic favorites. That demand has slowed down. And as a result, they're going to see negative same-store sales. Jharonne, always great to talk to you. Jharonne Martis there, Director of Consumer Research for the London Stock Exchange Group, helping us walk through the plethora of retail forward earnings that we're going to get this week. And kicking that off tomorrow morning is going to be Home Depot. She just touched on it, but let's dive deeper into it with Drew Redding, Bloomberg Intelligence's home builders analyst here. And I don't know, I mean, I guess we're building homes, but are we renovating homes enough where we're going to see any sort of material upside on Home Depot's earnings?
Yeah, so I think it's going to be a challenging environment for Home Depot through the remainder of the year. Consensus is currently pegging same-store sales down about 3.5% this year. And if you recall, during the last release, Home Depot guided the full-year sales being down 2 to 5%. Since that time, though, traffic coming into the stores has accelerated to the downside. So we do see some risk to the full-year numbers. And we think that some of that can continue into 2024, given where we are with housing and some of the headwinds facing the consumer.
And Drew, when we talk about Home Depot, when we talk about Lowe's, a lot of the conversation focuses on people and DIY projects, but how are sort of the professional aspect of customers faring?
Yeah, the professional contractor has been a key driver of growth for the industry over the last several quarters. It lagged in the early days of the pandemic, but it has really been the growth engine. We still think it's going to outpace the DIY segment, but we're seeing is that contractor backlogs are still at elevated levels, but they're starting to come down. So after these projects are being completed, we're not seeing them being replenished to the same extent. And that's part of the reason we're seeing a slowdown in big ticket spending. And we think that average ticket size could come down in the quarter. Now, when we think about the pros, it's worth noting, we do think this is one of the key growth opportunities for both Home Depot and Lowe's going forward. And once we get kind of through this housing downturn, we think there's a lot of potential and a lot of market share to grab there.
Yeah, I'm curious, Drew, just real quickly, though, do you think that, I guess, how surprising was this? Because I felt like when we saw these stocks and, for that matter, their revenue growth really going through the roof during the pandemic, a lot of people were saying this is kind of a pull forward, right? I mean, there's only so many decks you can build and refrigerators you can buy before, you've basically bought all you need to buy here.
Yeah, it's a great point. Some of the slowdown is definitely due to a pull forward of demand. We see that in a lot of the discretionary categories. They've actually called out a pull forward in demand in some of their appliance segments, their patio furniture, and their lawnmowers. These are things that if you purchase in 2020, 2021, you don't need to replace them in the next couple of years. So we're seeing growth in those segments start to slow, and that's definitely a contributor to what we're seeing in same-store sales.
All right, Drew, great to catch up with you. A busy day for you tomorrow. Drew Redding over at Bloomberg Intelligence. A closer look at the big earnings report that we're expecting to get out of Home Depot tomorrow morning in the pre-market here. Negative signs in front of a lot of those revenue figures, at least based on what analysts are keeping their eye on. Meanwhile, we want to get a preview of the latest U.S. inflation report. Phoebe White, head of U.S. inflation strategy at JPMorgan Securities, is going to be stopping by the big program after the break. This is The Close on Bloomberg.
Well, the countdown is on to the 2024 presidential election, and one issue high on the ballot box will, of course, be the economy. Bloomberg international economics and policy correspondent Michael McKee takes a look back at earlier challenges to incumbent presidents and what roles the economy and the Fed played in deciding whether or not they would keep their jobs.
Joe Biden, George Bush, or Ronald Reagan? His polls now, a year out from the election, are terrible, but you can't write him off. Two examples. Both presidents from the other party. One also deemed doomed a year from the election, and one who couldn't lose. Both proved a year is a very long time in politics and the economy. As Reagan geared up for re-election in 1983, he was coming off the second of two recessions, his approval rating well below 50%. Unemployment was 8.8%. The misery index, combining unemployment and inflation, 11.7%. The Fed's target interest rate was 9.5%, and mortgage rates 13.4%. A year later, it was morning again in America.
It's morning again in America.
Reagan won 49 of 50 states. Then there was George H.W. Bush. A year before his re-election campaign, his approval rating was 66%. Coming off his own recession, unemployment was down, the misery index was down, the Fed was at 5%, and you could get a mortgage for 8.8%. A year later, Bush lost to Bill Clinton. The difference? Under Reagan, the numbers were high but coming down. Under Bush, the opposite. So what to make of Joe Biden? His data are much more mixed. Unemployment, just 3.9%, still near a record low. Inflation, 3.7% and falling. Yet the Fed's target rate is 5.5%. A mortgage is 7.8%, and Biden's approval rating is just 37%. But a year is a long time in politics, as we've seen, and a lot can change. The one thing we know won't change, to quote Bill Clinton, for voters, it's the economy, stupid.
Michael McKee there. Let's bring in Anne-Marie Horder, the co-host of Bloomberg's Balance of Power, to talk a little bit more about this. And Anne-Marie, I thought it was interesting. I think it was last week here. There was interesting comments out of the governor over in Minnesota, a Democrat, who basically said Bidenomics is not actually the platform that the Democrats are going to win on in 2024.
Well, it's not, because if you look at the polls, what Mike was just talking about, and we did our own latest survey of these swing state voters, basically where elections are won and lost, the economy continues to rank number one on top of voters' mind. So 41% of respondents in these key critical states told us that the economy is the reason why they'd go out and vote, and that's what they're concerned with. But you look at some of the political capital that the president is using right now, his focus is on what's going on in Israel, Ukraine, China-U.S. relations. He's about to sit down with Xi Jinping on Wednesday. Those rank only 3%, 1% when it comes to what voters care about. And really, Romaine, the big issue for Biden also in these polls is that voters are looking to the former president. They're saying they were better off under him, and they trust Donald Trump when it comes to pocketbook issues, when it comes to the economy, when it comes to immigration and crime. They feel that they'd be better off under former President Donald Trump than under the current president.
Well, Anne-Marie, you have to imagine a lot of that comes back to inflation, and the hottest inflation in a generation. And of course, this is something that Romaine and I have been talking about, something I know that you've been talking about as well, that even though the pace of inflation is cooling, the numbers are still going up. The prices that Americans are paying are still a lot higher than they used to be.
Exactly. What you're seeing in the data is that, yes, the economy is doing much better, much better. Mike was talking about that 3.9% unemployment rate. This is a superlative that the Biden administration loves to tout, that unemployment has been under 4% for 21 months. But the fact of the matter is that voters are not feeling it because of inflation. And yes, inflation is coming down, or the rate of pace of inflation is coming down. But the fact of the matter is the prices are still so much higher today than they were 2 years ago. Mark Zandi from Moody's, the chief economist, says that an average family making a medium income is paying about $700 or more now than they were 2 years ago. Yeah. So, yes, the rate of pace is coming down every month. But if you benchmark where you were 2 years ago, you're paying a lot more for groceries, for gasoline, for rent, and just everyday items.
All right, Anne-Marie Horder, and you can catch her as co-host of Balance of Power, which airs immediately after this program at the top of the hour. We want to continue the conversation here about inflation and, of course, the big inflation reports that we expect to get tomorrow morning. Phoebe White, Executive Director and Head of U.S. Inflation Strategy over at JPMorgan Securities, joining us right now to talk a little bit more about that. And before we dive too deep in the numbers, Phoebe, I do want to pick up on something that Anne-Marie was touching on, and it was something that a Bloomberg opinion columnist, Betsy Stevenson, economist over at University of Michigan, I thought really articulated well. And this idea that there does seem to be this problem where folks on the ground, meaning just real consumers, are kind of conflating inflation with sort of price levels. The idea here that, yes, inflation has come down, but prices, at least the prices that they see out there on the shelves, out there at the gas pump, are still materially higher than where they would have been a year or two ago.
Yeah, they certainly are, and I think that's part of the reason why we need to see continued progress on the pace of inflation, as you mentioned. I think, and for that reason, tomorrow's number is going to be really interesting. I think you look at the headline CPI figure, I think we're going to see progress there. We did get a decline in energy prices last month, so I think we'll get the 12-month rate coming down from 3.7 to 3.3 in October. But in terms of whether, this fight is done, we need to look at sort of measures of what is the underlying trend. And for that reason, the Fed and markets like to look at that core CPI figure, stripping out food and energy. And there, we could see some stalling here in that progress towards getting core CPI inflation lower. We look for a pretty strong 0.34 month-on-month increase in core CPI. That would be the firmest since May. That 12-month rate staying steady right around 4.1%. That's still a very high level. And that comes after a pretty strong reading last month. We think we'll get another strong reading next month. So there's still work to do.
Well, that's what I'm curious about, because we talk about this trend line here. But if you go back and you look at kind of, I think it was in June or July, where a lot of those numbers hit, basically cycle lows. And we all thought, oh, here we go. I mean, remember headline inflation, I think got down to 3%, at least on a revised basis. And everyone said, OK, that's it. We're headed towards 2%. And we've been higher every month since then, and that's going to include the most recent month when we get those numbers tomorrow.
Yeah, so I think part of the challenge here is I think even core CPI inflation, though it strips out those volatile food and energy components, still is subject to some volatile, components within that basket. We see things like airfares down 8% per month in June and July. That's, pretty sensitive to jet fuel prices. So we need to still sort of dig a little bit deeper, try to get a sense of what are those more persistent categories of CPI inflation doing. And I think when you look at that, I'd say I'd discount some of the softness that we saw over the summer. I'd also sort of discount some of these firmer readings that we're going to get over the next couple of months. I think we have seen progress on inflation since late last year, but it's still sitting at pretty high levels.
Well, Phoebe, when we talk about the different categories, I mean, a conversation we were having earlier on the program was this change in calculation to health insurance costs that previously it had been sort of a deflationary impulse in overall CPI, now expected to flip to maybe something that's a little bit more inflationary. And with that in mind, I mean, is there any risk that this becomes a noisy print?
So, yeah, I think there are some things that you certainly should discount in this print, but I'd say, the drag that we were getting from those monthly declines in health insurance CPI up through last month is probably more of what you should discount. I think if we do get something like a 0.8% increase month on month in health insurance CPI, that's probably a little truer measure of what health insurance costs are doing. So I wouldn't discount that so much. And you think of, what's happening in core PCE, that measure actually does measure health insurance a little bit differently. So again, I would discount some of the softness that we saw in those readings, earlier. From what we get tomorrow, 0.34, some risk that it rounds to 0.4. You look at sort of the sequential annualized rate of inflation here, it could be running, 3.5%, 4%. I think, some of that sort of very high elevated levels I think are coming from some of these other components, things like used car prices, which are probably going to be maybe rising in the next 2 months as a result of the UAW strike and some of the disruptions to production there. Rent inflation, which is still coming down from very high levels, but we know that those are measures that are very lagged versus industry data. So again, when we look through all of this, I think sort of core inflation probably is running kind of on a more persistent basis, closer to 3%. I think the Fed is going to look through some of these swings, right, from those soft readings to pretty firm readings. And this is how, Powell sort of characterized it, right? He's talking about progress from the very high levels last year. He said the road to 2% target inflation could be bumpy, but that's another reason to sort of, look at the totality of the data. What's happening with financial conditions? Are we seeing continued slowing in labor markets? And when you put it all together, I think it's a reason for the Fed to stay on hold. Yeah. But it's another reason to keep the bar very high to begin easing. I think, it's higher for longer here.
All right, Phoebe, always great to get insights out of you. Phoebe White there over at JPMorgan Securities. A look ahead to the big inflation print that we're expected to get tomorrow. Economists on average expecting year-over-year headline CPI to come in at about 3.3% here. On a yearly basis, if you exclude food and energy, we're looking at about 4.1. Stick with us. We're going to set you up for what to watch tomorrow. This is Bloomberg. A busy day for markets. Here's what they're going to have their eye on tomorrow, and we start off with that inflation report here in the U.S.
8:30 a.m., those numbers coming in hot, and then all day we'll get to listen to Fed members talk about it.
Oh, wow. Barr, Goolsbee, Jefferson, Barkin, and Williams among the few, but it's also going to be a big day for earnings.
Absolutely. Before the bell, we have Home Depot kicking us off. An important read on the consumer and sort of on the housing market as well.
Absolutely. And if the Fed speak wasn't enough for you, how about some speak from two of the biggest investors out there?
We kick off with Ken Griffin tomorrow. A wide-ranging conversation, I'm sure, with Bloomberg's Sonali Bassett. That happening in Miami, 1 p.m. New York time.
And then right here on the big program in the 2 p.m. hour, Cathie Wood, ARK Invest CEO, going to be stopping by the big program.
I don't know what we're going to talk about. I think everything under the sun. It should be pretty exciting.
I think you could throw anything at her and she'll have a nice answer for you. Definitely tune in to us tomorrow. In the meantime, stick around. Balance of Power is coming up next. This is Bloomberg.